Okay, guys, if you give me an audio check, it'd be greatly appreciated. I'm checking Twitter. Thank you very much. Appreciate that. All right. Before we start, I asked you guys on Twitter to take a look at three videos that my mentor Larry Williams produced. They're not new videos. I mean, he's sent them out previously because of his website. He markets his website, ireallytrade.com. But I'm not. Hang on one second. I got something all over my screen. The It's not an advertisement for buying his stuff, but I've been on record before. I pretty much own everything the guy put out because I started really with him. But the videos I thought were pretty timely, considering the information that we're sharing, and it's coming right from the horse's mouth. So while Larry was my mentor initially in the '90s, some of the ideas that I learned from him, um, he obviously shared in his seminars and his books and his teachings and such. And I adopted a lot of those concepts, but some of the things that he um, taught and still teaches today, I don't agree with. Not because I don't think that they work, but I just don't subscribe to everything he says, despite him being my original mentor. Um, so I want to kind of like use that to segue into number one. Just because I use a concept or tool or have an opinion about something, don't let that be a stumbling block. And I've talked about this in other sessions, so I'm not going to harp on it long, but give me a couple of minutes to speak on this because it's imperative that you understand. All of us have a a mentor of sorts, regardless of whatever it is we're doing. In trading, obviously, it's very difficult to get your footing in this industry without having someone that's been in it longer than you, has experienced some of the pitfalls and obviously the successes that you're aspiring to have. But if you don't have a mentor, you're going to struggle because you don't have a baseline experience to reference. Okay, you're going through an experiential stage by first introducing yourself to the stimuli, and we're going to refer to it as trading here. When you get into the marketplace without having a framework or a basis to lean on in terms of, okay, I've been here before, this is what should transpire, this is what should happen, um, and if it doesn't come to fruition as you expect, what are the you know ramifications of that, and how should you react? What's the mode of response that you should have without losing your mind, okay, or blowing up all your money? And because Larry, and you can hear him in the video, he's just like me. He's a little bit of a braggart, but he has the brass to stand up there and say it. No one else has ever been able to do what he did in the Robbins trading contest, and it would have been amazing to see him close it at $2.2 million. Good grief, that would have been no one would have been able to hit that. I don't think it's going to happen um, for a very very long time unless commodities really go way way down. He had the good fortune of having a lot less margin requirements back then too, so that has a lot to do with it. Um, and I'm not trying to take anything away from him because what he did was amazing, but nonetheless, it would be hard to do given the margin requirements today. So you heard him say in those videos that back in the early ages of his trading when he started getting heavily into pattern trading, he stated that he introduced this idea of opening range breakout. And while some of that may be true, um, I believe that Toby came out with that before him. So the opening range breakout that was before Larry's. I think his treatise on it. Now he had his own introduction to tweaking some of those ideas, like all of us have. Okay, you really can't reinvent the open, high, low, and close. I mean, it's there. It's been there since the market started trading. But the way we finesse that data is unique to each of us. Okay, so when a mentor and myself, when we come out and say these things are mine, this is mine. I have done this. I have done that. Um, it is kind of like a signature saying, look, hey, I didn't learn this from anybody else, so I can't attribute credit to anyone else. But if you have some decency, if you use it, kind of credit me, and that's what we do. When we say that, it's not all ego. It's a matter of everyone asks us the same questions. As mentors, we are asked a million questions, and invariably, what's going to be asked is where'd you learn this from? Where did this idea come from? And some of the things that I learned are right from the guy that I told you to watch this morning, Larry Williams. But as it relates to his opening range breakout, I tried that a lot in my S&P trading and in my bond trading, and I just didn't have the stomach at that time. I have it now, but at the time when I first started, I didn't have the stomach to weather um, those periods of drawdown in the trade. And what I'm saying is when he talks about buying above the opening price, what he's essentially saying is he's looking for the market to prove to him. He needs to have confirmation. And while I don't need that anymore, I believed it early on because he said so. And again, I'm not trying to beat up Larry Williams. All I'm trying to say is I used his information and graduated to a different view on the marketplace as it relates to the daily range and short-term trading. And I personally believe that my style of entry, my power 3 concept, and using the opening price 180 degrees different to what he's teaching and still teaches and uses today is superior. And I think if you watched any of my work, you would quickly agree that that's the case. Um, when we talk about buying a market, you really want to be able to ascertain the levels that have the highest probability of supporting price and also repelling price from those lower levels up into a higher close. That's what you're looking for as a day trader. As an intraday trader, as a scalper, you don't necessarily need that. You can work with that reference point after the fact. For instance, in New York Open, once you have something priced in on the London Open, New York Open typically is a really easy trade. We're going to talk about that with the British pound today. But the idea of, and I'm going to do a little bit of a rendition of illustration. Okay, we have a crude open, high, low, close bar here, or candle, or whatever you want to call it, a range for the day. I'm going to draw it out here in a crude manner. And we're going to assume for a moment that we are a buyer. And some of you seen some of what I'm going to discuss, but I'm going to add to some of the things that I've said in the past to kind of like, we'll come back to that in a second. We won't need that for right now. We're going to assume for a moment that the market opens here, okay, and we'll make the range a little bit bigger. And what Larry's saying is that if he's predominantly bullish, okay, and I'm showing you the mindset, how I transitioned from how I learned from my mentor, him, Larry Williams, and how I learned how to view the market in a totally 100% contrary view of how he interprets price and 98% of everyone else out there in the marketplace. When you're bullish on the market, Okay, and trust me, you'll see this if you look at anybody's work. They all have very similar themes to what I'm going to explain to you here, but it's 100% different to what we teach or what I share. The opening price is here, okay, on the day. So we're assuming we're looking at a daily candle here or daily range, open, high, low, close bar. The open is here, and we're assuming prior to the open, we are expecting bullishness in price. Okay, when price opens up and it starts to drop down, okay, anything below that opening price, when it starts moving lower, the retail mind, okay, or less informed traders, that completely and utterly short circuits their whole interval for time for that trade. In other words, if they're bullish, it immediately gets pushed to the back burner, and they start second guessing their analysis. They start second guessing their their uh, their assumptions on what the market should be doing. Just want to double check the audio one more time. I should be okay because it's still posting on here. So I'm going to ask for one more second before we really get into the nitty gritty on this. Just give me one more audio check, please, on Twitter. I really hate doing this because it breaks up the continuity, but I just don't want to be wasting my time again like I've done in the past, talking and the mic went mute. Just one more audio confirmation that we're still broadcasting live. You guys can hear me. If you would please just post that to Twitter. Audio is okay. I'll continue. Thank you, French. All right, so when we are looking at a market that's bullish, okay, if you have way too much leverage on the market, okay, because if you've married the idea that you're right, you're absolutely right, you can't be wrong, and you leverage your account to the hilt, okay, and you can't accept the fact that you could potentially be wrong, and you see that initial start of a decline, okay, in the beginning of the day, what happens in that time frame is retail traders, weak-minded traders, they start second guessing, and they think, okay, well, I'm probably wrong, and they won't think I should be buying down here at a better, lower price. That's not what they do, okay? And I can tell you when I first started, that's the same thing that I experienced. Because if I was bullish on the market because the stochastics gave me a bullish divergence, okay, on an hourly chart, but yet the price kept going lower, that freaked me out. I didn't understand that because I thought the stochastics was driving price. But obviously, all it was doing is mathematically uh, plotting within a limited range. Okay, and that's why indicators are a facade. It can't continue to keep going lower. It just stays in a lower oversold condition and creates even more bullish divergence while it makes lower, 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 lowers. Well, when we have the expectation based on higher time frame premise, okay, when we have the understanding that the market will be reaching for a liquidity level, okay, or fair value level, and we'll talk a little bit more about that in this presentation, um, and it's above present market action or present market price, that is a bullish bias. Reason why is because where the current market value is right now, whatever asset class you're trading, and if there's liquidity above the marketplace that has not been tapped into, hasn't been traded to, hasn't been cleared out, hasn't been rated, okay, and we've come off of a very solid support level or order block, or it's recently cleared out some stops below the market, you should be thinking, okay, the market's going to look for liquidity above the marketplace because it's already absorbed what's below it. So now it's going to look for the other side above. Okay, so that's the basis for your bias. Okay, that's what builds your understanding that the market should have a bullish premise today. Okay, that's how it all starts in my mind. That's how I go into the marketplace on a daily basis. I break the market down like that. Is there more interest above the market where we're at right now or below the market? And you judge that by base where it is now, today, where when you're looking at the chart, and then where it's came from and how has it responded where it's come from recently. Has it been a dynamic response? Has it moved quickly away from the lows? If you're seeing market action coming off of a recent uh, support level or a bullish order block, and has it done that dynamically, and has it cleared out a level of liquidity above the current market price? Because if it's come off of something very strong on the lower end and in the form of support, it's classic support resistance. If it's bounced off a support level, okay, it's going to reach for a resistance level. Otherwise, what's it going to do? It's either going to go sideways or it's going to resume going lower. So you have to weigh these things out. And when Larry teaches and taught and still trades with this idea, you can hear him in his own voice and see his face as he's saying it. He requires a certain measure of like a pat on the back, like it's okay to do a buy now because it's already started moving for you. And what that means is while the market's bullish, okay, if he assumes that, for instance, the bond market is trending one direction, and that gives him a prognostication for the S&P. So by having that understanding, he goes in and builds this premise, bullish or bearish, based on those ideas. And I've talked about that in the past, and if you want more on it, it'll be in the commodity section because I actually give you my S&P trading and my bond trading uh, method in that tutorial. It's all rule based, so it's not like a whole lot of information. It's just very simple stuff. But assume that he's bullish. Okay, if the market opens and starts trading down, he's not buying down here. Okay, much like 98% of all retail traders, they're not buying down here. What will happen is he'll say, okay, here's the opening price, okay, and he'll look at the last 12 or 9 days average daily range, and he'll get 20% of that, whatever that whatever that average daily range is for the last 9 to 12 days. He'll add 20% to that opening price over the last 9 to 12 days. Now, I'm not saying this is how I trade. This is what I came away from. In other words, I saw what he was doing. I traded it with real money like that in the bond market, in the S&P market, and had to sit through some uncomfortable trades. I wasn't willing to absorb that kind of stuff. I just couldn't do it. I needed to be a little bit more correct in terms of when I got in, when I got out. So when the market's trading down soft, okay, right from the opening, while he's bullish, he's not doing any buying there. He's waiting for the market to go back above the opening price. Okay, and the opening price for him was the open outcry, the opening on the futures contracts. Okay, so it had trading hours. When the open hit, he called his broker. Boom, here's your opening price. He already knew what the average daily range for the last 9 to 12 days, and he added 20% of that range to the opening price. And once it did that movement above whatever that 20% is, okay, say up here is the 20% range, he's going to be a buyer there. Okay, uh, when I was trading this is what happened to me. I would see the opening price. I would do just like his rules stated. I would be buying 20% above the opening price based on the last week or two, and I would be getting along here. And then all of a sudden, the market would do this. It would trade back down to the opening price, okay, and I would expect some measurable support there, and then it would start to resume going higher. But it wouldn't do that. On a lot of the trades, it would do this. It would trade back below the opening price. And if it does that, that's the problem. And his ideas don't teach that. It didn't teach me. I never learned it from him, but I learned it from experience that when I was wrong, that was the earliest telltale sign that I needed to hit the off ramps and get out of that trade right away. But I wouldn't. I would allow the trade to go to full stop. And there's no reason to do that. There's no reason to do that. Absolutely none. Because if you look at what we have here, okay, when you're wrong and it opens, it can trade down a little bit initially, okay, and then run stops below the market, and then run the market higher, creating the projectionary state on the daily range. In other words, this is the Judas swing up. You end up buying near the high of the day, and then it comes down and it fulfills the daily range like this. So not only are you stopped out eventually, but you're demoralized because you ended up buying at the high of the day. His tools and his concepts did that to me a lot, despite having an oversold condition in the Williams percent R, despite having a 50-day moving average sloping up. Okay, that was his trend tool. Despite having commercials net long, despite open interest being a decline while it's consolidating, this still happened to me a couple times. And it only takes a really painful trade, and you've probably seen this in your own trading. You could have 30 winning trades out of a month, but you're going to feel the most anguish, the most depression, the most disgust about that trade that you lost on, and especially if it was a sizable one. It's going to eat at you like a cancer. Okay, and it only takes a few of those, especially trading with a huge amount of leverage, which is what I was doing as a commodity trader. I mean, I was trading with an astronomical amount of leverage. I didn't have very much room for price to come against me, and I simply just got lucky in the beginning. You've heard me say that. But once I learned the idea of buying above the opening price, in other words, buying strength is what the idea is, you're really not doing that a lot of times. Now, granted, there are times when it does this, and these are the ones that everybody talks about when it works. Everybody that sells things and teaches things, I do it. Obviously I do cover pages on when my stuff works, and you're going to hear me talk about it in grandiose about the cable trade I did today. But I do lose money. I've shown that. You've seen it. Okay. But the idea of it working when it does, this is what happens. The opening price, you're bullish. The market comes down initially. Okay. Makes the low of the day. He doesn't view that. He admits readily all over the place that he wishes he knew how to do that. Well, one of his students, you're learning from him now, me, has learned that, and I've shared that with you. Once the price moves above the opening price, 20% of the last 2 weeks or 9 days trading, okay, 20% of that average daily range, that's his fixed buy stop. He buys it on a stop right there. What will happen is the market will come up, boom, then come back down, trade into the opening price again or just above it, okay, and then it'll go up and create the range expansion on the day, and then give him a higher close. Then what he's expecting on the next trading day is he wants to see a higher opening than it was the previous day. So if it opens here, he's out right there. If it opens here, he's out. If he opens above the daily high, the day he entered, he's absolutely getting out there. Okay, so it's basically his concept is called bailout. Okay, it's pretty common. He's talked about it on the internet and his books and some of the things that you've heard me comment over the years. But I don't believe that's necessary. In other words, I think the idea of buying strength in that idea is a little stupid, really. I mean, I don't like that. And it's largely because of the lack of understanding of what's going on engineering the daily range. And when we look at time and price, okay, and I believe that George Angel has the strongest in terms of futures trading when it relates to time and price. And that's why I talk about it. Okay, despite what he got in trouble with for CFTC, claiming he made this and that, the tools work. Now, if you go into his sniper video stuff on YouTube, there's a lot of information that's really useful, even still to this day. Even though the SPOOS market and some of the things may not be readily paired up with forex trading, the concepts of application with time is absolutely critical to your understanding, especially if you're going to be a day trader or a short-term trader, because timing is absolutely essential. If you're going to be a swing trader, it's not as, in my opinion, it's not as important because you're expecting a larger move, so you can be a little bit sloppy in terms of your entry. You can be a little bit earlier because your stops are going to be wider, and because you're expecting a 500 to 1,000 pip move in terms of your profit, you can have a 250 pips stop loss and still have a really nice risk to reward ratio as a model for swing trading. But what I've learned over the years was that when you're buying above the opening price, okay, you are creating a necessity to have your stop loss to be a whole lot larger than necessary. So we're going to assume that we're buyers or bullish, and this level up here above the opening price, okay, is where you'd be a buyer. Where would your stop loss be? Because we've already learned in my work that they can still come back down below the opening price in New York, clear those stops, and then create the higher close on the daily range. Or you have to be below the low. Well, guess what? The New York Open can still come down and take out the low that's formed in London. Okay, so that's why I believe that everyone else out there that trades and teaches, they all talk about these opening range breakout concepts. And Peter Bain and this other guy, I don't know, it's Calhoun or somebody, I don't even know who he is, but they're still promoting this breakout strategy. Okay, and no, this is not a beat up session, but I'm just trying to tell you that there is a better way of looking at price that's a lot more methodical, and it flies in the face of what everybody else is doing, which is exactly what you want to be doing as a trader. You want to be in the minority, okay? Because if everyone's losing their money, they're all doing the same shit. So if whatever that is, whatever that stuff is, okay, you need not do that. Whatever that is, this 180 degrees different, be diametrically opposed to what everyone else is doing. And guess what? It's going to be very uncomfortable because you're going to feel like, well, the herd's going north. I'm going to be the only one going south. I'm exposed. The predators will see me easy. I'll be hidden in the herd if I trade like everyone else. That's why everyone does what they do. Because it's like this. Well, if everybody's doing it, if I'm wrong, I won't feel so stupid. Well, how about if I'm right and everybody else is wrong? How awesome is that? That's the paradigm that has to take place in your mind. And you also start to not give a shit about what everyone else is thinking. You don't want to know what anybody else's opinion is. I don't give a damn what anyone else thinks about the British pound or the euro or the dollar when it relates to my trades. I don't care. And in fact, when someone tells me their opinion, I immediately go in looking for the reason to do the opposite of that. I'm 100% contrarian. I didn't start that way as a trader. I went in trying to be a pacifist and say, okay, I'm going to agree to what everyone else as my mentor says, and I'm not going to deviate from that. And it was very difficult to follow those rules, and I lost money. And I hate being wrong, and I've admitted that. I'm the average Joe. That's why I've started this stuff teaching in 2010. I'm telling you how my thought process started in the mid 90s. With the struggles I went through, trading commodities, all those things, okay, they're all real. They're real things. They're all experiences I've been through. I've done all that stuff, okay? So what you're feeling isn't new. You're not the first person to feel all those uncertainties and fear, okay? So that's why it's important to have a mentor. But don't limit your uh, development to any one or a group of mentors. If you feel led to go a different direction, but being uh, inspired by something that they give you. In other words, if I give you something in terms of information, don't lock yourself into that. Don't think that, okay, well, this is the only way this is going to work. Because if you do that, what you've done is you put blinders back on. All you do is exchange the set of blinders I've taken from you and replace them with your own. And you're going to have this limited, myopic view of only what ICT says. Don't do that. Don't do that. Because had I done that, I never would have been who I am today. I wouldn't be able to see the things I'm seeing today because I would have been closed minded. I would have said, no, 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 this is outside what my mentor says. And I believe me, I see some of you that are real quick to defend me on the internet and ready to go at it with some people. Okay. And I did the same stuff. I defended Larry Williams all over the forums. When people were telling me this, that, and the other thing about him, I wouldn't hear it. I would be on there. I would spend more time, defending the guy than I did, researching what they're saying. And some of the things that they were saying were valid points, but I was closing my ears to it and not looking at it. And once I experienced it in my own trading, I was like, well, I got to revisit some of these ideas. And the the Power 3 concept, which is the open, decline, buying near the low of the day, okay, and then waiting for the range expansion move to take place. We don't need to be buyers up here, okay, because it creates a need for your stop to be larger. And if your stop has to be larger, that means you have to have a smaller position. And smaller positions do what? It makes you feel like you're not doing much, right? You know exactly what I'm talking about. If you have $1,000 account, okay, and you're only trading 10 cents per pip, you're not caring about that trade. You're really not caring about it. So you have to have um, a little bit of skin on the line. You got to have some flesh available. If you're not risking something, you're not going to care about the trade. Okay, So once you graduate into live trading and you've proven yourself consistent in demo, once you start taking trades, they have to be um, positions that you care about. You can't be so minute and so little that you're afraid to take risk, because you're going to learn by taking risk what you're going to need to do, because eventually if you are profitable, your money is going to grow. And what you're doing with $1,000 account now will be 100% different psychologically, okay, when you're trading with $100,000, okay, and when you're watching the open position that you're holding go up and down several $100s in minutes, okay, it's going to have a little bit different feeling internally than you have when you're only trading with $1,000 equity base. And eventually, when you start to move into a larger trader and you're trading $1 million or more, trust me, you're going to need to know these things, because the level of fluctuation that the volatility creates while you're in a position, be it profitable or not, doesn't make a difference. When you're watching your position move $5,000 to $6,000 in minutes, up and down, you have to graduate to that. You just can't jump right into that. You can't. And in the 90s, when I was blowing my account up, not blowing it up like where I don't have any money, but I took $2,600, and after initial drawdown, I had to learn some things, but I ended up taking it to $832,000 inside of 9 months. Yes, it was all luck, but I can tell you that my stomach was completely eaten. I was eating myself alive because of the stress. I mean, I was watching my account move $40,000 a day. That's, if you're not ready for that. I mean, $40,000 is a lot of money. If I lost $40,000 now, I'd miss it. But back then, I just couldn't tolerate it. I mean, I was always in a state of panic all the time. And when I was making money quickly like that, I was still equally panicked, because I didn't know. I was like a deer in headlights. And it's because I didn't have the experience. And I only looked to the mentor that I had. Well, what was the mentor at the time? Larry Williams. He's the cowboy of trading. He had wild equity swings, and he admits it. He's like, there it is. And that's why I still have that in me, and I can absorb some of it now. But back then I couldn't. But I was trying to teach myself, well, this is how you have to do it. You don't have to do it like that. Okay, you don't have to do it like that. Trust me when I tell you, that's not the way to do it. Okay. So when we have our tools give us indications that the market wants to rally, okay, once we get the opening price at 0 GMT, okay, you want to see, is there a willingness to go below that opening price? If there isn't, now this is really important. If I've bored you and you've zoned out, okay, dial yourself right back in, okay, really pay attention. If you're looking for daily bias and you're wanting to be a buyer, okay, at 0 GMT, when you get the opening price at the new day 0 GMT in that reference, you want to see, is there a willingness in Asia to go below that opening price? If it doesn't, if it doesn't want to go lower, okay, and just starts to drift sideways or slightly up, you're going to be paying more attention to the opening price at midnight in New York. And then the same idea will be, we're going to assume that now this opening price is the midnight candle opening in New York. What candle opening is that? Well, you can use an hourly chart, whatever the opening price is on the hourly chart. Price is price. It's going to be the same thing. It can't change it, and it's not going to be that you're only be splitting hairs. But the opening price here, we're going to say represents the opening price at New York's opening in New York at midnight. New York time, midnight. Okay, so that opening price, you're going to monitor that. Again, we're going to assume that we're still bullish and that 0 GMT was not seeing any willingness to go below its opening price. It was slightly sideways to up. Now you're going to be paying attention to the opening price in midnight New York, and then you're still going to be looking for the same idea that price will want to go below the opening price. That is going to be the Judas swing, or the moment where the market goes into a protractionary state where it leads traders to chase price going down. And it's also taking liquidity out of the marketplace. That's correct. Okay, they want to take out the stops that have been trailed up too tightly, and take individuals and put them in on the wrong side of the market, breaking it down. Okay, so when it does that from the opening price down below at New York's open, and there has been no indication that Asia or the 0 GMT opening price has been worked below, okay, you know there's a high probability that the Judas swing is going to occur from the opening price at midnight, and it starts to trade down. When it starts to trade down like that, okay, your mind needs to immediately get real comfortable with wanting to be a buyer. Trust me, it's going to feel like it's the worst thing to be doing. It's the wrong thing to be doing. It's screaming down. It just dropped 15 pips in 2 minutes. Michael, you're telling me I should be buying it right then and there? Yes, absolutely. Absolutely. Because that's going to be the low of the day. Not every day, but a large sample size over the course of 6 months, if you look at data, if you're bullish based on the ideas that we teach and these phenomena take place, and everything I just said, if you want to look for sells, just reverse it. And that's why you have to take notes. I'm not going to lay it all out there for you. You're going to take some notes and go through the process of what I just explained and reverse it for selling short. But that's the reason why we look at two reference points for openings on the day. 0 GMT, how do you filter that? Which open do you use? Well, I just told you. If you're bullish, the premise is the idea is we're looking for bullishness. Okay. If it's going to be bullish, and we're going to use the cable today as an example. The opening price at 0 GMT, that's what we look for. Okay. And if it doesn't trade down below the opening there, okay, and it starts to drift higher going into New York, in other words, the whole entire Asian range, if you start seeing it go up or sideways, you know that what they're doing is they're going to wait until New York opens in midnight in New York time. And then the movement will start right at midnight when it trades down. You really want to be hunting for bullish order blocks, the liquidity below the flow, and where are they going to manipulate price? It's very simple. Very, very simple. It's not requiring any kind of harmonic patterns. It's not requiring any Fibonacci's. It's not requiring moving averages of any sorts or indicators. It's just understanding how the daily range is engineered. Okay? Once you have that mindset that you don't care about what everybody else is worrying about. I'm not worrying about what overbought and oversold readings are showing up in the RSI. I don't even worry about it. I'm not worrying about what the commitment traders are saying right now. I'm not worried about what sentiment is. I'm not worried about open interest. I'm only understanding that the daily bias that I arrive at on a daily chart is indicating that price wants to reach for a level above the marketplace. Okay. We talked about, let's put this in a real world setting so it kind of makes a little bit more sense to you because I'm probably rambling on to most of you. But trust me, what I just said to you is exactly what I wanted to know, but I didn't know that I needed to know that when I first started. And it's kind of a weird way of saying it, but it's true. When I first started, I didn't understand the vacuum of knowledge that was between my ears. I didn't have any idea what I should know because I was only experiencing my learning through books and VHS tapes. That's it. And a couple live workshops and video, seminars. That's not enough. And I've learned that the best stuff that people really use to make money, they don't share that. They don't do that. They don't do it. They may make a derivative of it or something similar to it, okay, where everyone else can see what they're doing when they want to show those results, and they'll say, "Well, yeah, yeah, that's what he teaches too." And it's really not. the the things that you see me doing here, okay, and the way I explain it is exactly how I trade. Okay, some of you get really in depth in terms of breaking down what I've done in terms of trades, and because it doesn't fit a specific video or it doesn't fit a criteria that I've talked about, um, the quick assumption is I'm not trading my own rules. You don't know everything I know. I haven't shared everything yet. Okay, but we're going to talk about some of the ideas that in some of the questions I've had been sent to me by Twitter. But let's go and look at the dollar first, and we'll bring this information into a real world account today. And uh, yesterday we were talking about the dealer's flout and how to build the template. And at the end of the video, I gave expectation for what I thought was going to happen going into this week. As it related to the dollar, I said that we were in the midway point or mean threshold of this up candle. Okay, and last week was basically all one direction going up. I said that we would probably see the dollar. Notice I'm saying probably. I did not say absolutely it's going to happen. Bet the farm on it. I'm going to be right. I did not say that. Okay. I gave, obviously, like everyone has, the two conditions that's going to most likely happen. The market's going to go up or it's going to go down. The fact that we moved up one-sided, okay, and we moved into this range here gives a little bit more, uh, I guess, probability that the market's going to have some measurable correction. Okay, I did say that we did not want to see the market come back down below this low. Okay, if it does come down, we want to see it come down to here. So deciphering that, it's basically we are in an overbought condition based on price action. I don't need a indicator to tell me that, just for completeness sake. And at the time of our discussion yesterday, the market had come out of an oversold condition right in here. Okay, but we knew when price get to this level here, that would be oversold anyway, based on the price action. I don't need an indicator to tell me that. Okay, when price was up here in this level here, it was overbought. We didn't need the indicator to tell us that. Okay, this indicator on a 10 period didn't even go overbought on the indicator, but yet sold off. So indicators, you don't need that. You have no reason to even require putting an indicator on your chart. Now, you will see me talk about this indicator in particular when it comes to commodities and some of the rule-based ideas I use for day trading. So I will come back to this idea, but it's not something you absolutely need. Okay, but initially, if you're a new trader, it does help when you use certain rules. But by far and large, most of these indicators are abused, and they're used way too often and demanding rather panaceas, and they're not. So with the market having priced in one-sidedness all last week, I just want to check my audio. Okay, the because the dollar has been one-sided last week and it's come off of our level that we anticipated seeing a bounce at, we would see price most likely try to correct and go lower. If the dollar is going to go lower, obviously that's translating into what for foreign currencies across the board. You should see strength in all the foreign currencies. Now, if you've looked at Forex Factory's calendar, if you looked at the calendar on Forex Factory, you'll notice that there's bank holiday in the euro and on the British pound. Now, bank holidays are a little sneaky, okay? Just because it's a bank holiday doesn't mean that the price isn't going to be moving around. In fact, a lot of times, the bank holidays, you'll see wild price movements, okay? And they'll drag price to an area of liquidity to upset positions, okay? And what I'm going to suggest is we have this expectation in the dollar. We're going to assume for a moment, okay? We're going to assume that we had an idea. If we sell off, okay, we're going to be looking for this low down here as that's the maximum we want to see it trade down into. And it's also, if you look at the down candle here, it's about midpoint of that also. So everyone asks why do I say these candles? Why should it not go below this level? It's a combination of things I've already taught. Okay, and you have to break down your charts going through those same ideas. I'm not changing things around. I'm just giving you a greater detail on what it is I'm looking at. None of this stuff has really changed over the years except for a greater detail of why I spend so much emphasis on specific things. Okay, so it's the mean threshold of this candle and it's this low here. Okay, that's the reason why I don't want to see it going below that low. Okay, so I just answered one of the Twitter questions out of the way. So the cable, this is what we had. Let's zoom in a little bit. All right, so we have the cable. I mentioned that there was equal lows down here, so if we did sell off and we traded down to that level, I'd be interested to see if it'd be willing to snap out of that. Could be a raid, but if it comes down and breaks through here and has momentum going lower, we would be trading back down into this bullish order block. Okay, that was the bear side. The bull side is it's all been one-sided, much in the same vein that we saw on the dollar. Dollar being bullish all last week, every day. Cable being soft every day except for Friday. We had a little bit of a consolidation and pop. Now, we have all this range in here. Let's put a fib on here. Got a swing high down to our low. Okay, and price goes right back up into equilibrium, midpoint of that range. We're going to drop down into an hourly chart. Okay, day dividers on. Right now, price trades right up into equilibrium. If you go over to the left side of your chart, this is also a point of consolidation, and we have a bearish order block, which is where price rapidly moved away from. It's the up candle. Okay, and let's take our fib off now because we've already established that's the fact. Right in here is above the market from where we opened this morning or yesterday during Asia. Okay, when we started trading here, above the market, we have what? Stops that would be above this high, above this high, above this swing high, above this high, and all the way back up to fair value. Now, what is fair value? Fair value is where price started its run. Okay, we have a fair value price here, and we have a fair value price here. What's making it fair value, Michael? What's the, why do you say that? What makes it fair? Well, price stayed in a consolidation at that level, so it was fair here. Something upset that balance in price. I don't know what those fundamental reasons are. I don't care what they are. I don't need to go through bank reports. I don't care to study the fundamental data because I can see it in the chart. They're going to know more about it than I do. And trust me, I've tried reading that stuff. It's over my head. I can't understand it. So there it is. So instead of beating my head against the wall, trying to force myself to understand something I'm really not interested in anyway, I'm not a numbers cruncher. I can see charts. I can see what price wants to do based on that. So that's my strength. I live there. I bloom where I'm planted. So having the expectation of seeing when the market moved away quickly from this consolidation, where did it start from? The up candle here. So the up candle here in the midpoint of this body, here's why I did that. This would be fair value up in here. Now, when it gets down here like this, okay, the market goes into a consolidation and it starts weighing, is this price justified or is it too far gone? In other words, is it too cheap? If it's not too cheap, they'll drive it lower again, and you see it, they run it lower again. Okay, so you have 2 points of reference here. You have this one here, and you have this one here. When price stays in a consolidation, but then it moves away quickly from it, the consolidation and or the order block itself, the midpoint of the consolidation and or the order block it moves away from, they are your points of liquidity. Now the ranges that are built in the quick moves away from that, okay, all this in here is fair value. Anything in here can be fair value. Why is it fair value? Because these are the least traded prices. It moved too quick in here, okay, to give every possible opportunity to get fills in these prices. In the down moves like that real quick, there's going to be pockets, little gaps, little spaces where there's a lot of potential in terms of trading specific price levels, but they didn't get the opportunity because at one point it could have been trading here, and then the next print in the market was down here, and then it gapped again down here. Maybe it came back a little bit, but never came back and gave this opportunity of filling up to this price, and it just kept doing that. So it creates this porous price action that creates a willingness, like when we traded commodities, when they had open outcry only, today's open would gap from previous days high and or close, and the market will have a strong tendency to close that up. It would be called basically a common gap. Common gaps generally get filled 70% of the time really quick. Well, when you see this in price action like this, these real quick moves, this is basically a common gap. It's not a new theory, it's not a new idea, but people don't look at their charts and see that as, okay, well, this is where price is going to be want to go up in here. So when we have our charts, get the right one here, Michael. When you open your charts up, okay, this area up in here, all this from this wick in here to this low here, this is what I would deem a really good area for fair value. It doesn't mean it's going to go right up into this area here, top of that rectangle, and then that's it. It's not going to go anymore. But this is the highest area that is the most thin. In other words, there's the very least in terms of volume was presented in terms of trading rate in here. Now, price could go all the way back up here and close this entire range. I don't necessarily need that to build an idea that where price may go. And there's another one below the marketplace, okay, in here. Okay, we have this little bit of a range in here as well. Now, when we look for fair value, this is fair value, this is fair value, and we opened down here on Sunday. Okay, market opened unchanged. We're inside the middle of the consolidation that was created on Friday. We came off of Thursday's low in here, moved in consolidation, and then what did we see? What did we see here? At the beginning of the trading day, we saw the market unchanged and drifted lower. Then at 0 GMT, okay, right here, the opening price is 141.31. 141.31. And price goes down and creates a move to 141.23. Very little bit of a movement, and then starts to move up. So we have basically unchanged. So we have this candle here. We're looking at an hourly chart. This is 1300. It's 9 o'clock, 8 o'clock, 7, 6, 5, 4, 3, 2, 1, midnight. Okay, here's midnight right here. 4 GMT. If we go in and look at the opening price on that, the opening price is 141.38. What we would be looking for is in a move that goes down from that. Okay, you want to see a move from that opening price down. Once it trades down, that's the protractionary state that you're looking for, much like we saw here. Okay, so we saw the market move from the opening down. In here, the market opens, okay, and trades down. We want to see it trade down, not just trade down by, definition of, okay, it went less than the opening price. It's got to go down to a point at which it makes sense. Why would we anticipate the market to move up from whatever movement below the opening price brings us? There has to be a reference point, liquidity based, okay? And that's coming in by way of this. Here's that 4 GMT candle, the opening price. You want to see price move down, okay? When it moves down, it's going to have to go to a point of liquidity. Okay, an institutional driver in price action. Well, what's this? Right in here, what is this? It's the down candle prior to the move up. There's your order block. Right here. Maybe if I can draw the line, it'll help you. Good grief. Here we are. Okay, so you have your order block here. Price trades down, and we're going to drop down into a 15-minute time frame. Okay, this is what it looks like before the day starts to really unfold. Sunday's trading, 0 GMT. We had the initial move down below the opening price. Okay, what's happening here? It's running below the lows that were created during the initial opening range. And all the bodies in here, you see that? Forget this wick. Remember we talked about this the last, I think it was the last, not the very last session we did live, but the session before it, we were talking about the Canadian dollar. You look at the bodies of the candles, okay? Look at the bodies of the candles. That's where the bulk of the volume is. And wherever that is, just below it, that's where stops will be resting. And you can see that's what we did. We went down and cleared it out. We did not clear out that wick. I guarantee you, on this particular candle, every one of us is going to have a different low. Okay, 141.22 is not going to be the same thing for everyone on March 25th, 1400 GMT. It's going to be a different low, guaranteed. I'll put money on it. That's why we look at the volume that's created with the bodies of the candles. Okay, hang on one second. My children are on spring break and they're getting Bella all worked up, so she's making herself known. Hang on. Okay, so we had price move initially down, clear out some stops, and then started the rally up. Okay, when I woke up last night and was looking at London, I had already missed the move in here. I missed all this, so I can't chase price. I can't do that. So what I did was is I waited for New York Open. I knew back here the model had already been built in that they priced in the low. Asia supported buying, and then we had the London Open session. Okay, it created some more buying. The market opened here at midnight in New York. We traded down. Okay, and this candle right in here hits the order block that we saw on the 1 hour chart. That's what this is right here. Look at the reaction here. Pop, snaps up. Okay, we have a really big uh, uh, impulsive move away from that order block. But now we have this big candle here. Okay, had I been up a little bit earlier, paying more attention to what was going on, but because it's the day after the holidays, I really wasn't that uh, excited. We have this order block in here. Price comes down, hits it, bang, 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 and then boom, it explodes. Okay. Once it started running in here, it was too late. I couldn't do anything with it. I had to sit back and wait. But now what we have is price showing, okay, it's showing the willingness to want to go higher. And hang on one second. You will be muted now. Hang on one second. Okay, so one more audio check, please, guys, before I resume. I'm checking Twitter just to see if my audio is good. Thank you, French. All right, so back to business here. So I woke up late, obviously, and I missed this opportunity in here. Okay. Now, folks, when you see this right in here, I already know some of you are saying, well, this doesn't fit the criteria. Why doesn't it? Why wouldn't this fit the criteria for those that are, if we were in a room right now, we were face to face, because I already know some of you are going to say this doesn't fit, but it does. It absolutely does. The we see institutional pricing respecting the buying, and we have a frame of reference, the bullish order block that's arrived at looking at the hourly chart. It comes down, hits it, it respects it. They recapitalized that price level, and there's some buying clearly. Okay, so they bought more in this down move. So you're going to use that order block here, the down candle prior to the move up. If it trades back down to that level, it's buying. They're going to recapitalize that price level. What price level is it? 141.40. Okay, so they like 141.40. They believe it's a fair to undervalued price level. Why is that the case? Because look what they did. They bought it. More of it was bought up. Now, when we have the next session for New York, once you see London post its willingness to go one direction or another, in other words, we've seen the indication that it wants to go higher. Right now, we're in the 10 o'clock hour. 10, 9, 8, 7, 6. 6:30 is when I start watching price for New York. Right in here. And there's the beginning of the New York kill zone. Okay, it's going to be 11 GMT on this particular feed, but it's 7 in the morning in New York time. That's the actual time. So I start watching around 6 o'clock, 6:30. I'm really usually in front of my screens at 6:30, and I want to see if there is some measure of retracement going back to create the buy opportunity that is seen in New York. Once we have the established daily range already shown and proved to us, okay, when we delineate the day with the kill zones. Now again, the question was, can you give me the times for the kill zones? Wherever you are geographically on the planet, whatever that location is, and whatever the time is, and whatever your time is on your platform, your trading platform, you're going to have to do the work to figure out what I'm looking at in terms of the kill zone, when it begins and when it ends. And I'm telling you, they don't deviate. In New York time, okay, at 7 in the morning to 9:30, 10 o'clock, okay, that's the last bit of, the kill zone I like to use for New York. The best is obviously 7 to 9. I like that sweet spot in terms of time for the New York Open. London Open, I look at 2 o'clock in the morning to 4 o'clock in the morning. That's like the sweet spot. Okay, that's like the best times for the higher low to form in London. Okay, but I have a graduated time window where I will look at it as early as 1 o'clock in the morning New York time up to 5 in the morning. Okay, so it's a little bit larger. So when I'm really looking to key up on the higher low of the week, I'll start my trading and hunting around 1 o'clock in the morning New York time. And if I don't get the signal, or if I miss it, or if I lose money by 5 o'clock in the morning, I'm usually packing it in and taking a nap. And you'll see this type of action in London lunch. Okay, that's what this is right here. This is all London lunch. You'll have a typical retracement trading down, and it'll create the opportunity, sets up for the New York trading time. Okay, so when we have price in here creating this low here, and we saw the willingness to want to run up, okay, when price takes off in here, I knew that we already had back in here priced in the idea that it was going to go higher. Now, how much higher will it go, Michael? Before we get into the entry, let's talk about that. Let's go back out to a 1 hour chart. Put some more data. Okay. Down in here, the market had already rallied up, and now here we're seeing the London lunch retracement. Equilibrium is up here. We have fair value over here, and we have fair value over here. Okay. We're looking for a move to run the stops at this level. This level. And I'm going to give you the reasons why I believe these are salient in a minute, okay? Just give me time to paint these things on here. Because I didn't do it ahead of time. I actually enjoyed some sleep, so deal with it. So, alright, now we have our levels in here. And then we have our bullish order block. I'm sorry, bearish order block. Fair value, and then the upper level order block back here. So when price is trading down in London lunch, okay, going down, creating the retracement that's typically seen going into the lead in to cross over into New York Open. Okay, this is what you want to see. Classic chart pattern, bull flag. Not that it makes a difference, but you can see it in here. Why would this level be significant? Well, think about it. It's a bank holiday right now. Okay, UK's experiencing a bank holiday, so is the euro. And the banks, just because they're not able to let you do banking there, doesn't mean they stop doing business. They're doing their business too. There is no bank holiday where they're not making money, and transactions are still going to be be going through. The dollar being sold off is going to do what to the British pound? It's going to prop it up. So above the market, everyone's made money going down last week. Okay, so we have stops here, we have stops here, we have stops here, we have stops here. Okay, so with a unchanged open, the down move right from the opening on 0 GMT, the buying of the order block here, respecting it, respecting the 15-minute order block that was created when it stabbed down into here at that order block as well, that we just talked about. We'll see it again in a minute. We come back, retraced, okay, and then entered into the New York Open kill zone. Okay, the New York Open kill zone. Time of day suggests what? We should see a continuation of what's already established back in London. Okay, but New York creates another way of interpreting the same daily range from the 0 GMT to tomorrow's 0 GMT, that entire range. Okay, that range still can be fulfilled on the upside. Why? Because nothing's changed fundamentally. The bank is still under a holiday. The dollar's still weak, and there's liquidity above the marketplace. And when there's a bank holiday, this is generally what you see. They'll run the market against whatever's had the prevailing profitability. If it's been going up, it'll retrace going lower. If it's been going down, it'll retrace higher. That's generally the rule of thumb with me. That's what I've seen in my experience. Okay, and today has been no exception to that rule. We go back down to an hour. I'm sorry, a 15-minute chart. Leave our hourly chart here, and we'll zoom in a little bit. So we have another opportunity in here where the market has the opening or 7 GMT. Okay, and price trades down a little bit. Okay, when it trades down, Larry Williams' idea would be add something to that price here and buy up here. Again, that would stretch open the risk. You don't need to do that. All you're going to look for is the willingness to want to move away. Okay. Once it does that, and you have an engulfing candle or a move that's impulsive away, showing you the willingness to want to be a buyer. Okay. Once that occurs, go back to the left. When you see that, okay, that'll give you the reasons to justify being a buyer. Not sure why my mouse pad's acting up, but it certainly is today. All right, so we have this candle here. It moves away. Price comes down, taps it here. Basically, what you're doing is you're going to take this candle here. The high is 141.68. How many pips? And I can't hear you, obviously, but how many pips do we say we add to make sure we get our fills? 5 pips. What's 5 pips added to 68? 141.73. So you would be buying, okay, 141.73. Now you can do that um, at the market when price is trading there. You can do it as a limit. You can do it as a buy stop. Once you see a retracement down here and you think that this is going to be the catalyst in here as well, you can do it as a buy stop. You can set your limit to be a buyer there. Not buying strength, adding percentages of a daily range and being a buyer up here. You're buying close to the low. Low of what? The New York session. Because price is fractal. If you start breaking down your trading sessions, look into the New York session and really study it. If it's been an up move like we have here so far, it looks like the traditional power 3 open to decline by the low of the day, range expansion, close on the high of the day. And that's going to be a small little fraction or a fractal of the daily range. Just like if you broke down the London Open or the London session, the same thing can be said there. Okay, everything is fractal in price, but without having reference points in relationship to time of day, adding a premise, building a confluence of things. We saw the dollar selling off. We see the willingness to see the cable go higher. It's in a bank holiday, so that means they're going to really drive price to where the liquidity is, and it's going to be quick. It won't meander. It won't get this little drifting, slowly but surely dragging you to those levels. It's going to run there because it's thin right now. And if you understand the right side of the marketplace on those environments, it's really fun. And today's an example of that. But that was the basis for my long on cable today, and where it was reaching for the overall direction on the day. Obviously one-sided. And if you look at the euro pound, yesterday we showed that it was going to reach for those stops above the marketplace right up here. Okay, hit those stops, and here's where we're at today. Softer. Okay, if we go into a 15-minute time frame, and it's a little bit more data than that. You see price comes off, it hits those stops above the marketplace, quickly runs away, goes in consolidation, breaks down, and trades back into an area of liquidity right over in here. Okay, so it closes this gap, trades down into an order block in here. If this pair is going to drop, and the idea was that we were going above the market, clear out those stops above the market. We've moved lower. If euro pound is going to drop, what are the conditions with that? Okay, what does that mean for us as a trader for trading euro and cable? If euro pound's dropping, the conditions are this: that the cable's going to rally and euro is going to be held in consolidation, okay, or the euro is dropped and cable is held in consolidation. Now, if we go and look at the indications that we were getting out of cable, it was saying that it wants to go higher. So we can expect what to unfold. The range will expand on the upside in cable, so we can be a buyer and not anticipate the consolidation in this pair. Okay. If you look at the euro today, we had this bullish order block we talked about in our presentation yesterday. Said that it would be interesting to see if we would have some buying in here right on this candle in here. And if we go into a smaller time frame, okay, here's that order block. We just extended out in time a little bit more. Okay, price drops down. This drop right in here. This candle occurs at 11 GMT. That's the New York session kill zone. It's the beginning of it. It drops down. Okay, it drops down. Why is it dropping down? It's going to an area of liquidity, institutional reference points, bullish order block, the down candle right here prior to that move up. Okay, here's your order block. Use midpoint of this body of the candle as a mean threshold. be a buyer there. Hits the main threshold, boom, explodes to the upside. You have your order block here. We have a pennant formation in here. The midpoint of that, you have this order block here. So price could still see a move up to 112.15, 112.20, thereabouts. If we clear out that swing high, the range that's exposed up in here would be the next objective. If we see dollar continue to slide down. At 112.45 level, I'm using the big bold candle that encapsulates all of this price action in here. I'm using this equal low with this low here, more reference to the body, not the wicks. Okay, and we have a high here too, so that's the reason why I like that price level. So 112.45, nice 5 level that we would use anyway. It could spike into that 112.50 level on the upside. So what else were we talking about? Let's look at the dollar on the lower levels. We talked about it on the daily, but let's take a look at it on an hourly basis. You can see the breakdown in here. And 15-minute as well. Nice return to an order block. Nails it to the pip. Low 96.28, high of the candle 96.27. Am I wrong? Is that right? Low 96.27, yeah, and the high is 96.27, right to the pip. Again, I counsel you go and look over the internet and see if that exists anywhere else except for where we're at. Our camp is the leader in terms of precision, so enjoy it. Bask in the greatness. All right, so we have the US CAD. This is one that I expected to see if we saw upside to clear these highs here and use this liquidity to drive us up into this point at which we would close the range. It still could happen this week. We have a little bit of a range down here. It could still fill in. Scenario here is we could come down with the dollar weakness, close in this gap, and then come back and close this area up here. So we can get both sides of the marketplace this week on US CAD. Aussie dollar. We had similar expectations like in the euro. We had this bullish order block here. We were expecting price to see if there was any strength in buying. In here we would use the middle of that candle is a mean threshold. I'm just eyeballing it, guys. And then today, you can see on an hourly basis, we had a real nice reaccumulation. Propulsion candle, which is a higher order block based off of the parent price swing low here. Trade right into that order block here and expands up, clears out the equal highs in here. Upside resides at, there's 2 reference points on the Aussie. We have a breaker here, and then we have, should it continue a little bit more, in here. Why am I using this one and not this one? Because it's got too much wick. It's got a body and a low on this candle here, the low on this candle here, and all the lows in here. So I think this is going to be the level to watch on the upside, 75.87. So basically 75.80 institutional to 75.90, small round number. That would be handsome on the upside. If we lose the order block here, this was just posting the high of the week. There you go. I do believe that's enough for my discussion today. Um, Looking at what we have on Twitter, I have I'm sure a lot of questions. Um, from this moment on, okay, I'm going to work my way down in the list. That means I'm capping the questions from where we're at right now. Um, was my British pound long entry similar to a Judas swing, but in the new, yeah, basically I just covered that. So yeah, it's basically a Judas swing here, okay, but I used the order block here as a means of entry, and you can see price action response after that. Um, what broker do I use for live trading? I generally don't disclose that information, but I do trade with a prime broker. All right. When the dollar bounced from bullish order block, how can we tell reaction from a last low or the next low after that low? This is from Solid Pips. I think if I understand what you're asking, is that we go to a daily. This bullish order block down here, I think this is my understanding or what I think you're asking. So if I'm wrong, just retweet it after we do our presentation, and I'll try to clarify it in a tweet if it doesn't do it justice here. Um, but when the bullish order block, is hit, how do we know it's not going to be a reaction at this low here? Is that's my understanding, um, and it's because I discussed in the last two presentations about this dollar setup is that if we see weakness and willingness to sell off here, if it's bearish, the premise behind a bearish market is what support's going to give way. That's what you expect to see in a healthy down move or a healthy bear market. Support levels give way; they break. Now translate that into inside of institutional order flow. You would see bullish order blocks give way or be, you know, um, absorbed. This down candle here, okay, if we're seeing bearishness and we have a really strong parent order block back here because this is the biggest price swing in here. So we're all inside of the range of this high and this low. So this low, while it did come down into the majority of this open range in here, it left some unfulfilled range still. And price likes to return back to where it had a lot of buying before. And price, if it's bearish up in these levels like we were showing, support in a healthy market would give way. This bullish order block should be absorbed or breached, and it was. And if it does that, the next order of business would be to expect this to offer some buying in the form of a bullish order block, or expect support come in the marketplace, and that's what you see here. Okay, so if that's answered your question. If it didn't, just tweet back after the session, and I'll do a little bit more. Uh, a third trade setup could be London close entry and exit next day London open. How come this isn't covered in any of your tutorials? I haven't taught everything yet, so I understand what you're asking, but these are all scenarios that are all part of things that we'll discuss when we close the Market Maker collection. How much of my success in the last 10 years is attributed to FX versus getting lucky in futures? My luck in futures was only those 9 months initially. Um, my first trade was an orange juice option. I lost half the option. I paid $1,500 for the option. I lost $750 in 1 day of the premium. And I hurried up and collapsed the trade. Got scared, and I had to learn some things, obviously. But the period of time I took off and learned what Larry Williams taught. Um, Once I started back up, I didn't recapitalize. I used $2,600 minus the $750, and then I traded that up to $832,000 in 9 months. That was all the luck. Right after that, the market entered a time where I needed to be a trader. Everything stopped going up vertically. So once that happened, I absorbed about 2 years and a month of just steady losing, and I just couldn't take it anymore. I had to stop, and ended up getting my oldest son, you know, in a custody battle with that because my oldest son's not with my wife, and I had to do some things that we won't talk about here. But once I got my things squared away and learned exactly how to trade, it was straight from there up, and I graduated into a greater understanding. About 2002, I would say that was the best turning point where everything really started clicking, and I made a considerable amount of money from that point on in my own trading. And yeah, you got a lot of questions here. It's a little it's a little hard for me to track as you asked a series of questions, and I may be not doing myself or you justice by reading them in reverse order. But I did take a trade today. You see that today? I did that. What I'll have to answer some of these on Twitter. The I mentioned market reversals happen in New York Open and London Close. Sometimes the day just reverses daily overflow in London Open. The market doesn't generally reverse in London. It's usually posting its daily high or low. And my method is aimed at trying to ascertain what that most likely will be. Will it be the high or the low of the day? Because if you have that going in, you're only going to be looking at one thing, and you're going to be focusing on one thing and a model that fits that criteria. And if you're right on your higher time frame premise, which generally you're going to learn that my stuff does that for you, um, you'll come away with, even though you'll have losses here and there, you'll start capturing a great deal of the average range on a daily basis if you follow the rules and hold to London close. If you do that a couple times a month, you'll come out well ahead. And you only need, like I've already proven, 25 to 30 pips a week to double your money every single year, only risking 2%. So if you do that and you're able to risk 2% on your trades, and you're getting 4, 5, 8 to 1 uh, returns on your setups, you're doing extremely, extremely well. And you don't have to take every single trade. Unless I actually send you a direct message, you probably can't send me anything. So if you're sending me stuff and I haven't responded, it's because of that. Um, does the dealer's flout concept carry over to the S&P futures? If so, what are the times? It doesn't work like we're using it for a foreign exchange, but there are some things that I teach with the S&P trading. It's basically rooted in what would be was Globex at the time when I was trading futures. So we'll talk about that, but not in this session. It'll be in the commodity section. So right now, looking at sit still, Bella. Uh, right now is British pound USD movement only to allow euro pound to retrace to a certain level, so the latter would continue. I just yeah, Chrissy, I just mentioned that when we referred to the euro pound. Why don't I automate my trading since I'm heavily rule based? Well, to be quite honest with you, um, I don't know how to do it, and because of the proprietary nature of how I trade and how I have traded it, for me to automate it and not have the capacity to do it myself, um, I would have to sit down and have someone understand how I trade, and I wasn't willing to share that with anyone. I mean, a lot of the stuff that I do, no one else does it, and I wanted to maintain that edge over everyone else. But because of where I'm at monetarily, I don't need to worry about that anymore. And regardless of what my kids do in trading, if they choose not to do it, then they're still well off. So I have a different mindset about it now. I used to be very stingy and wasn't never going to show anybody this. I was just going to keep it to myself, hoard it, and there it is. And when I started thinking that way, I became an ugly person. I was very arrogant. You think I'm arrogant now? You have no. You wouldn't have been able to tolerate me. It would have been ridiculous. Um, so that's the reason why I don't automate it. But you guys, if you choose to automate it, you got enough of it now, and you can, if you want to do it, go ahead and do it. Um, how do we know if market structure is really broken or it's just a run on stops speed? I keep going back and forth on that. Okay, Electus, you have to take in consideration where that daily chart is suggesting it wants to move. Okay, if it's wanting to go higher, if it's wanting to go lower, you have to come to some measurable conviction and stick to that side of the marketplace until proven otherwise. And if you can't do that, trading is going to be very difficult for you because by having a stance on the marketplace, whether it being bullish or bearish, it's important because it gives you a baseline. If you don't have an opinion about what the market should be doing, and if it doesn't translate into seeing that happening in your trades or your expectations being fulfilled in price action, you will not have a way of discerning if you were accurate. Therefore, the trade, if you're in or about to take, is viable, or if it's not coming to fruition and your expectations are not coming to pass in price action, then you have to be able to have the willingness to reverse and change the direction and be flexible there. Now, there are times when I anticipate market structure doing one thing or another, okay, and it doesn't work. So it's important in your development to be able to expect some of that to occur. You won't see it as an occurrence of you being wrong. You're going to be expecting the tools to be absolutely 100% correct every time. But your interpretation of them, like everything else, will skew those results. So when you're expecting market structure to break, okay, if you lean heavily on what the directional premise is on the weekly and daily charts, at least the daily chart, uh, market structure ideas will be very favorable for you there. But if you don't have these higher time frame premises in mind, you're going to see whipsawed type things where you think market structure is breaking up when all it was a raid on stops above the marketplace. Okay, and I went around the long way of saying just basically this: if your higher time frame premise is bearish, expect highs to be violated, but understand that they're only sell stop raids. I'm sorry, buy stop rates. In other words, it stops above the market short-term highs. If the overall direction's bearish, I love looking for stop runs above swing highs in those conditions. That's some of the best trading scenarios because even if you don't get in right when it runs the stops, it's already run the stops. So now you have a stage where the market will really quickly want to move away from that high it just rated. So it really propels the market to go lower because it's already took in new liquidity above the highs. So those that were already trailing their stop loss down in an overall bearish market based on a higher time frame, if you see those conditions there and you start looking for market structure ideas for bearish setups, they will work like near perfect. But again, it's all hinging on the higher time frame premises. All right, guys, you guys keep asking new new questions, and it keeps pushing my feed lower. I got to be able to track where I'm at. Um, what is the criteria to anticipate the 6FX daily templates? You're asking to learn what I'm going to share this weekend ahead of time. Shame on you. Exercise some patience. I promise you'll get it. Where are we at here? Here's a lot of questions. What do I do from Friday's close up to Monday's opening, getting ready for a new week of trading? Um, I do the majority of my sleeping on the weekends. I try to rest as much as I can. Um, if I can see a setup based on my analysis on, like, usually Saturday morning, right before my kids get up, that's usually the best time for me to do analysis because I let them stay up really, really late on Friday nights, let them watch whatever they want to watch, usually a movie or two, and when they can sleep in, and my wife would usually generally like to sleep in, it gives me the opportunity to do my analysis. Okay, and I just break down the markets from a higher time frame monthly to weekly, and then to daily and 4 hour, and I break them down with order blocks, see where the market will most likely want to reach for, and then the setups that are the most favorable. I kind of like focus on that. I generally keep a notepad next to me. If I'm out and about and I'm managing positions on uh, my notepad on my iPad, I'm sorry, my iPhone, I have lists of things that I want to be able to keep track of. And because I'm always out and around, running around, I have to have those thoughts on paper, and I don't carry pads with me when I'm walking around, obviously. But looking at hang on one second, guys. Okay, sorry for that. Had to let Bella out. I'm so unprofessional. So yeah, I just basically break down the market from a top-down analysis, and I look at any news events that took place over the week, especially going over the weekend. If there's anything that may cause some unexpected volatility, like terrorist attacks and things like that, um, those types of things, unfortunately, we have to keep in mind and look for ideas that may cause some reverberations in price action. But I do everything I basically tell you guys to do, and while I don't spend hours upon hours doing it, it usually takes me about 30 minutes on a Saturday to break down everything I want to look at and anticipate going into the new week. Um, how do I place orders and when do I place orders? Well, um, given the recent volatility, it used to be I would see, man, you guys keep hitting me with new ones. Um, I would go in around 12:30, wake up, and see if there's anything for me to trade in London. I would set my limit orders there, and my order would be um, contingent orders. In other words, if it's filled, my stop loss order would be X, my profit level would be Y, and it would be completely autopilot. And I would wake up around New York and see what transpired. But because it's become really volatile lately, and things have been a little hairy on the geopolitical front, I really want to be up and take the trade usually and a manual entry. Okay, I'm just going in right when it hits a level. I feel closer to the market like when I'm doing that. So majority of my time in the last 6 months has been market orders, um, but taking profit sometimes is at market as well. But sometimes it's been limit. But generally, I teach the idea of going in with limits. But in honesty, in the last 6 months, most of it's been market orders. How to tell the difference between Judas swing and a normal move if incorrect, which will stop you out. Well, you know it when it happens. You don't know for certain. I appreciate your level of uh, respect in terms of my ability to be able to do that, but it goes largely with what I've been saying so far, for the last 5+ years. If you have a higher time frame premise in mind, If it's bullish, Judas swings will be going down, and they won't go down very much. They're limited to 0.33 percent of the last 5 days average daily range, and that kind of like defines it really really nicely for you. And you also have to use what we just talked about this week past, the dealer's flout. So having those ideas will give you a basis to build the trust on whether or not it's a Judas swing or if it's really going lower and continuing to fill the daily range. Kate's indicator. I'm going to take that and upload it to a folder I'm going to create for indicators. I've been resisting on creating a file for you because I know I'm going to be adding things I can't show you yet because we haven't taught the material yet. And I know I'll get a million questions about what's that other indicator you have in this collection that you haven't talked about before. And it's just going to save me a whole lot of questions and answering before the fact. But I'll at the time of this recording's finished posting, once I know it's made it to your hands, I'll upload that indicator to my website, and I'll send you guys a link on Twitter for it. Uh, you mentioned where we are going in directional premise. Aren't there always bull and bear? Yes, there's always. Yeah, that goes without saying. But the largest probability of where price is going to go is going to be slanted one way or the other on the daily chart. And if you can ascertain that, build an idea to anticipate that happening, then obviously you're going to work within that realm and only focus on buys or sells based on that understanding. Uh, you know, if you can be a you can see a down day in the marketplace and still find sell signals in that. And I've said this before. Chris Laurie teaches how to trade, intraday volatility without having any relationship to daily bias. And while I know that can be done, I have always been an opponent to that idea because I think the majority of your time, once you understand what you're doing, is to develop the side of the marketplace where it wants to most likely go and trade that side only. And if you're using volatility concepts intraday, it will put you on the side where you'll nail it and you'll kill it. So my my whole point in teaching, what I do is I try to look for where the highest level of higher time frame movement is going to most likely reach for. Okay, is it going to go for a higher level than we're at right now, or we're going to go to a lower level? And if you break it down, it's really simplistic. I mean, it's not rocket science. It's where is it most likely going to go from where we're at right now? Is there more reasons to see it move higher, or is there more reasons for it to move lower? If you can just do that, and it's a very hard thing to do if you're a new trader. Trust me, I'm not trying to minimize it, but as a new trader, you want to just arrive at one decision or another. You're only going to be looking at the bull side, or you're only going to be looking at the bear side, and that's one of the cool things about seasonality and times of the year. If you can trade specific times of the year and do very well and move to the sidelines on other parts of the year, for instance, you want to be a buyer in the fall. You really want to be a buyer in the fall. So if you're a buyer in the fall, um, everything that we use rule based and tool based will be looking for buys below the opening price, Judas swings going down, bullish order blocks, and only living there. And expecting to see bearish order blocks give way, resistance levels giving way, seeing the load form on Tuesdays and Wednesdays, and it makes trading very easy. But the problem is no one wants to live there. They all want to do everyday trading, and I'm not an everyday trader. I've recently done it in the last month and a half or so, but it's only because I was in a contest. But I don't trade like that normally. I don't care to. I don't need to. But I just did it to show that there's a way for everyone to take these tools and make them their own. And it's nothing else beyond that. It's just you have to come to the decision you're going to trade one side of the market, and until that can be changed uh, clearly, you have to work in that realm. Okay, and Once the market proves otherwise, trade it, keep milking it. Once it's giving you a tip of its hand, okay, once it shows you its cards, if you will, okay, just roll with it and just work with one side of the marketplace until you get a reason to not want to say that's the side of the market to be on. um, you won't learn anything. And as a developing trader, it's nothing wrong with assuming that the market's going to go one way for a month and only work that side of the month. Okay, I've taken traders to a level of neophyte to a really solid understanding doing that very exercise. I asked them up front, okay, look, right now pick a currency, and they'll say euro generally. And okay, so now what do you want to be? You want to be a buyer or a seller, but you can't do anything else but that one thing for the next 4 weeks. You can't do any other trading except for being a buyer or a seller, but you pick it right now. And I try not to influence them. They'll ask me, what should I do? And I'm telling them, you make a decision. I'm not telling you how to trade when you put your trades on. So you need to come to the decision of what you're going to do for the next 4 weeks. It's training. It's not profitability. It's training. Okay. It's designed for you to follow the rules, whether it's profitable or not. Because once you grow into an understanding of understanding the directional premise, once you get that figured out, and it's going to come by experience, you'll have already ingrained in your expectations on what you should be doing as a trader, following rules, sticking to them, and you have seen what it's like to not be right and not worrying about it. Okay, you're going to be looking at the law of averages. Okay, over the course of a month, there's potentially 20 trading days on average. Okay, but you only really got what, 12 really solid setups that are possibly there, and you really fine tune it, you got about 4 to 6 absolute cream of the crop setup days. And don't take my word on it. Look at it. Do a breakdown on a month to month basis on one currency pair, and you'll see that's the law of averages. So if you spend your time as a new trader starting out with picking one side of the marketplace, regardless if you're right or wrong, who cares? That's not important right now. In the beginning, you need to learn discipline. You need to learn following an approach and not deviating from it. Because once you understand by experience what you should be doing with these tools, okay, because trust me, you're going to learn more from being wrong than you are when you're learning when you're right. Trust me when I tell you that. You're going to learn more when you think it's going to do something and it doesn't. You get more learning from that than when you're seeing positive results. Because when you get positive results, what are you doing? You're sharing it with your friend. You're sharing it with your wife. You're telling your kids how much you're going to make in the future. You're planning vacations you ain't made money on for. You're doing all kinds of things, and you're fluffing yourself up. You don't need to do that. You need to worry about what's going on in the charts and start at one reference point. That means pick a direction. Don't deviate. If you say, okay, in April, when April 1st starts, the new month, I'm going to be a seller of Swiss franc, or I'm going to be a buyer of Canadian dollar. And that's all I'm going to do for the entire month. And I'm only going to be looking for reasons to justify those trades for the entire month of April. I'm suggesting that as a idea. I'm not saying do that, okay? But I'm just saying you as traders, when you first start, you got to work in a small little sandbox, okay? Do it in a demo setting and teach yourself to follow an expected procedure. Don't worry about what I'm doing. I've already shared that. It's in the trading plan development. It's all there. All that stuff is what I do. Now, it seems like a whole lot, but I do all those things inside of 5 to 10 minutes. For the two pairs I do, and I look at the dollar, it's 30 minutes. There you go. Now, if you're looking for a shortcut, I don't have any of that. But you're going to have to go through the things I'm talking about now to get the understanding that you want and you know you should have. But there's also an understanding that you don't even know you need yet. And you'll realize it once you start going through these types of events and exercises and processes of learning that can't be articulated in me telling you. Trust me when I tell you, you will experience certain things that you didn't know were important to you until you face them face to face. And believe me, you'll know exactly what I'm talking about when you hit it. And it's all going to be experiential. And you're going to all uniquely experience it at different times. There's no specific, okay, in 2 weeks it's going to feel like this. In 1 month I should know this. It doesn't work like that. This is why it's the most difficult thing in the world to learn, because it's all uniquely driven based on your mental capacity. The thing that's in between your ears is the biggest barrier to you getting to where you want to be at, because either you won't relinquish what you think is right and what you believe is the way it's supposed to be done, but that's stupid because if you haven't been trading before and you go into this, there's nothing like this. There's nothing else out in the world that you can say this is parallel to. It's completely outside the normal. What you think should be this 90% of the time, it's the opposite. That's what works. It's it's deception. It's unruly. It's deceitful. It's a beautiful opportunity. It's the last bastion of enterprise. It's capitalism as its best. It's whatever you want to call it. Okay, but the bottom line is there's nothing like trading. There's nothing like it, and you have to treat it like something that's absolutely going to hurt you, and you have to respect it and go into it very slowly, okay, and learn where your niche is in the marketplace. And until you do that, okay, and I've given many ways to be able to carve that out with the tools. You can be a day trader, you can be a short-term trader, a position trader. Um, you're not limited. You're not limited, and I've done all of that, and I have learned that day trading and short-term trading is my forte. I excel at that because I'm very short tempered. I'm very uh, analytical, and if I spend too much time on something, I'll change my mind about it. So I can't be a position trader. Swing trading is very difficult for me because I have to really be convicted and say, okay, come hell or high water, this is what's going to happen. And because I talk about the markets, it makes it difficult for me to be a swing trader, in recent years, because I can change in a dime based on what I see on the smaller time frames, and I still have that tug of war going on as a trader. So to avoid all those problems, I know that I can do very well day trading. I can do very well short-term trading. So I live there. I excel there, and I'm very precise in it, and I make a whole lot of money doing it that way. And I don't need to do anything else. But you won't know how to do that, okay, until you go through these processes yourself. How do I advise and pick and manage a broker specifically when our equity is growing exponentially? Well, I can tell you this. When you get around $500,000, my advice would be to split your account up and put it in two or three more reputable brokers. I wouldn't keep that much money in an account. But when you get to about $1.5 million, you really want to sit down with someone that has experience in setting up prime brokerage, and you need to be doing very well trading, and you have your credit's got to be really good. There's a lot of things that need to be in place to do that, but once you get to that level, you need to come out of the leveraged side of trading and just go deleveraged. And if you're trading with $1 million, even with $1 million deleveraged, you're doing quite well, very, very well. And we've already shown that 6% return a month, you're doubling it. So if you have $1 million account and you're doing 6% averaged over the year, you're making $1 million. So it's not a stretch of imagination. When you have $5.5 million sitting in an account, you're doing 6 to 8% return. Do the math on that. It's very easy to see why quarterly taxes need to be done. There's a lot of advantages to doing deleveraged trading. Once you have seven figures in your equity, the whole world changes. Everything that you think you're feeling now, you won't want to be in leveraged accounts when you get to that level. Trust me, you won't. You won't want to be there. You won't want to be there when you get into around $250,000 to $300,000, because when you have leveraged account, yes, the wins are great, but you're going to start thinking about your money a whole lot differently than what you do now. You don't want to lose it. You certainly won't want to be risking much money then. Can I explain who are the central banks and reasons of why they move price? They trade during the general retail hours. Well, the central banks are who they are. Central Bank of Japan, Central Bank of the United States, Federal Reserve, Central Bank of Canada, Bank of England, Bank of Germany. They're all the major banks. And if it's a problem for you when I talk about my opinion on how the central banks operate, because it does sound like a lot of conspiracy, I do sound something of a quack that folks don't like that side of when I talk about it. And that's because it makes them uncomfortable, and it should. That's why I tell it, because we're not out in their background. I'm sorry, their backyard, making millions of dollars. okay, and they're out there just making it available to us. That's not how it works. We're not supposed to do that. That's their business. They want to be doing that to us. And if we have a sober mindset about what trading should be, um, I think it's a better way of doing it instead of saying, okay, let's sugarcoat it and say, it's an IRA mentality. Let's get in here and invest, and everything's going to be great over a long period of time. I think it's rather myopic. Obviously, in the last 8 years, 10 years, the level of corruption has been made very apparent. Everyone knows it now. And it needed to be done sooner. It should have been exposed a lot sooner. But it's always been that way, and it's always going to be that way. It's never going to be, free of corruption. Uh, Before daylight savings time, true day was 5 to 20 GMT. I assume now it's 4 to 19 GMT. That's how I interpret it. Yes. Entry techniques. All those. Some of these questions are actually answered in the last two installments of Market Maker, so I will defer some of those to that. I know a lot of you are impatient. You want to get to the end of the game, but it's just a little bit more of a wait. If we have a strong higher time frame bias on a pair, should we expect a small retracement, not a large move against our bias? That is relative to each setup. There's no real framework outside of the expected what you would see in intraday. I'm assuming that you're referring to a day trade. Generally, what will happen is if you're bullish, you'll see the Asian market create the low. If it doesn't, you have a 70% chance it's going to create the low in London Open, and it'll start its move in London. Usually, it'll make about 60% of the daily range in London Open. Generally, it'll move up that much, and then it'll retrace during 5 a.m. GMT to 7 a.m. GT. I'm sorry, 5 in the morning New York time to 7 in the morning New York time. Okay, there'll be a retracement. It'll usually go sideways or consolidate, or retrace lower. Okay, and then set up another move going higher into New York Open, and New York will post the average daily range over the last 5 days generally by 10 o'clock in the morning New York time till noon New York time. That's the general template of daily ranges on the up day. Down days is the reverse, everything I just said. But the amount of retracement is going to be relative to what that daily range should expect to see based on the last 5 days average daily range, what the central bank dealers range projections are, what the range had been for the London Open already. And all those things are factors you have to weigh out, and that's why some of this material takes one video to talk about one specific thing, because there's a lot of detail that you have to have. But that's a good question. When you emphasize the importance of previous day's highs and lows, do you mean the true day or whole day's level? I will incorporate the true day level, high and low, predominantly, because I've seen majority of the time the actual high or low is in that range, but I still will reference the 0 GMT to 0 GMT, just to have that in mind. But I like to reference the true day format, yes. The idea behind his concepts was very useful, blah, blah, blah. Okay, yeah, thank you for that. Um, Mike, your teachings. Yes, everything I teach is how banks speculate. There are a lot of proprietary um, tools to trading in the banks that I don't know. I don't know a lot of the stuff that they do, but what I was exposed to, uh, I you're seeing it now. Some of the things I can't share that are very specific, but I can assure you you don't need them to be profitable. When a pair is in consolidation, are there any clues that you look for to determine if the break will be up or down? Yes, the dollar index. If the dollar index is going to go up, they're going to break down. And you go to, if you're going to be a cable trader or a fiber trader, you're going to go to euro pound first. So that's all part of the procedural thing. You start with the dollar to decide whether it's going to be bullish or bearish. If it's bullish, the next thing you should be doing is looking at euro pound. If euro pound is not poised to go up or down and essentially stay in consolidation, you got one more lead pipe cinch notch in the belt that's going to be a good candidate to be a euro or cable trade based on the dollar. Again, say the dollar is going to go down. You want to see euro pound consolidate, and you want to see the euro and cable failing. One of those two currencies will fail to make a lower low. So you have USDX S&T divergence, and that'll give you the strongest pair to trade on the upside, and assuming that the euro doesn't make a lower low. It doesn't mean the cable won't go up higher. It just means that the euro is probably a better buy. Um, and then you just look for the Judas swing to occur below the opening price and be a buyer there and wait for the daily range to unfold. If you do it on Tuesday and Wednesday, and the premise is that the dollar is going to go down for a series of days or potentially could do that, that sets up one shot, one kill scenarios there. You could be trading the low of the week on Tuesday and Wednesday and holding for Thursday's London close or Friday's New York open. And generally, that's usually about the scenario that unfolds for one shot, one kill. But it all hinges on what the dollar's doing. Drop 5-0. How does daylight savings time affect the almost all of your time-based tools? I ignore it. I know a lot of you guys are really keyed up about it, make a big deal about daylight savings time. I think it's a bunch of shit. I wish it never would have been introduced. Um, I just all my tools, even though they are some of them are very highly selective in terms of time. My kill zones are not 1 minute kill zones. They're 2 and 3 hours, 4 hours in length. So that's why I do it that way. Um, if I was going to be highly sensitive to daylight savings time, I would do daylight savings time and use the 2 o'clock and 4 o'clock hours only for the London Open in New York time, and I would only use 7 o'clock in the morning, 9 o'clock in the morning for New York only, based on what the daylight savings time is in North America. I ain't got time to keep up with all that crap, so I just have a range of time, okay, a session time that I work within, and I stick to the order flow, and that's it. If you have that, it doesn't matter what time it is. I mean, the order blocks aren't moving all around your chart. The last bearish order block is where it is. You're not going to come back to your chart and say, well, it was there on the 1300-hour candle. Now it's on the 1500. They're not making it that hard for you. Okay, so while time is important, it's not going to be that important that daylight savings time is going to be a factor whether or not you're profitable. Williams accumulation distribution indicator and volatility breakout, please. Okay. Um, the accumulation distribution indicator, a couple of years ago, I asked a few of you that were willing to sit down and chart, or not chart, but create a MT4 indicator, because I don't have one for um, MT4 that I believe is good. Um, I have one because I do trade uh, two of my accounts by way of TradeStation, but for MT4, because I teach in that capacity, I want to have a indicator that is very solid, that I see that works. I've had a couple of them sent to me, and I didn't agree with the output. So I will say this about um, the Williams percent R. I'm sorry, Williams accumulation distribution formula and such. I believe that that tool is one of the lesser known tools that are, if it can be applied to MT4, is really good. And there's a way of engineering it, because if I can get one of you to really accurately program it and code it for MT4, then I believe that by making a couple adjustments, I'll show you how you can do something that Larry Williams hinted about but didn't teach. And it was in he did a video set. There was 4 videos, VHS tapes, back in the 90s, and it was his Futures Millionaire Confidential Trading Course. And it was, in my opinion, it's really good. If you can get your hands on it, it's real hard to get. A couple people on eBay sell it, but um, I don't know if you're going to get a good copy or not. But the information that was on those 4 videos, in my opinion, is the best in terms of commodity instruction. It's real simple stuff. It's not hard to get through. He makes it very palatable, and it's very rule based. So, but when I'm talking about Larry Williams here, accumulation distribution indicator is a cumulative line that plots the relationship to the open and the close And we as traders, we are taught to worry about what the open is based on yesterday's close. And Larry, come up with the idea that if you could build a cumulative line on the net change over every day's uh, movement from today's open and the close, if there was a up move and a higher close today, there would be a cumulative adding to that line. Okay, but if there was a move from the opening to the close down, okay, that cumulative line would have a lower value today, so that way it would tick down. Well, in times that occurs and the price makes higher highs, okay, on the chart it looks like it's breaking out the higher highs, but really what's happening is it's being distributed. And I believe that is true. I believe it's very indicative, okay, but there's a way of taking that indicator, and I just can't, I don't know how to code for MT4. I have a degree in computer programming. I learned COBOL, CICS, and Pascal and C programming, but I don't have the patience to sit down with MT4 and do. I just don't have it. I can't do it. I don't need it because I have it on TradeStation. But I've asked the community that I work with, and you are a part of it. If you're listening to this, if you have experience in trading MT4, if you can get the formula for Larry Williams accumulation distribution formula and code that in MT4 format, I don't believe you need to have volume. He uses volume in the calculation, but if you remove the use for volume, just don't even include that. You don't need it because really what you're using is the reference point of the open and close, and use the value in terms of pips or points from the opening price to the close. Have that as your factor. Don't even use volume. Okay, you'll still get the same output. But nonetheless, the the relationship that you're plotting is the open to close, okay, and that's going to be the professional activity. What happens after the open is what professionals do. The difference between today's open and yesterday's close is what the retail minded traders think about, okay. So my idea is this, and I'll tell you the reason why I'm interested in it. Larry Williams said um, if you plot the differences between the close of yesterday and today's opening, okay, if you look at that relationship, plot that on a chart in the same vein that you do the open to close relationship for the accumulation distribution formula, because what he's plotting with that indicator is his interpretive view of professional activity from today's opening. What happens? And I think that's valid. It deserves a merit of investigation. And I've seen over the years that there's some merit to that understanding or expectation and seeing in price action. But he doesn't give you an indicator or formula to show the relationship of how the public would be acting. And if you could just reverse engineer that indicator and just plot the cumulative line relationships from the previous day's close or previous candle's close and this candle's opening. Now, I already know what some of you are thinking. Well, the opening of this candle is going to be the close of the previous candle. Yes, in Forex, that's true, but not on daily candles. Okay, so that's what I'm looking for. I'm looking for daily and the relationship over a longer period of time. You'll be able to see accumulation, and you'll also see at the same time that the commercials, not commercials, listen to me, the smart money, okay, would be buying, okay, the lows would be making lower lows, okay, over a period of a couple days or maybe a month or so, but the higher high in the cumulative line will be showing you the professionals actually accumulating all during that same time period. So what I want to show is if you could plot that Williams accumulation distribution formula and overlay the same indicator but plotting the difference of the previous close and today's open, or previous candles close and today's or next candle's open, having that as a cumulative basis, what you'll see is there'll be a disparity. It'll be like an SMT divergence. One of the lines will go higher, but one of them won't go higher. And you can forget about looking at all the highs, because think about it. All of our price platforms have a degree of variance in terms of where the highs are and where the lows are. And some of them are really crazy in terms of disparity. But the open and closes and the relationship of the overall movement going down, making a low and high, those that phenomena can be very easily seen through with like an X-ray perspective. I can show you an output that I use on TradeStation, okay, where it plots it, because I did it on TradeStation. I can do it on TradeStation. I've done it. But I know by doing something with TradeStation, I'm going to have 4,000 of you, okay, send me emails about how to do it in TradeStation. And can you do this and do that? And all of a sudden, I'll be inundated with all kinds of other things I don't want to be asked about. So I've asked the community to come up with a way that they can create the Williams accumulation distribution formula, and also plot the cumulative line on the previous close to this candle's opening, and plot that together, and I do it as an overlay. And if you do that, I promise you, you're going to see something about accumulation distribution that no one pays attention to. They don't see it. It's not there. It's anybody else's retail platform. They're not doing it. But I'm telling you, I see it on a day-to-day basis on TradeStation. When I plot commodities, or I look at indices, and I look at the forex markets, I can see the distribution and accumulation as it's happening. As it's happening, right before these explosive moves happens, there's a divergence between the relationship of the cumulative line plotting the change of the previous close and this candle's opening, the open to the close of this candle. Okay, so there's the two reference points. When you're looking at the retail side of things, it's going to be two candles. When you're looking at smart money, it's this candle. What's this candle's opening and close? What's the close of this candle's action? Is it up or down? If it's down, you're going to subtract that value in terms of points or pips, and subtract it from the previous candle's value when you plot it on a cumulative line basis. And I know a lot of this just went way over your head, okay, but trust me, the guys that do a lot of indicator building, they know I'm speaking their language right now. They know exactly what they want to do to go in there and start monkeying around with it. But that's a challenge for you guys to do, because I can't do it myself with MT4. I just can't do it. But I can show you output with TradeStation, and it's very, very telling, absolutely telling, when smart money is coming right in there and buying it up. It's making lower lows, but you can see it's not going to go lower. It's only going down to absorb some new buying, and then all of a sudden it just takes off and explodes. It's really fun with the commodity market, but it works just as effectively in the foreign exchange market. But that's all I'm going to say about that. I spent a lot of time on that question. Let's see here, moving right along. I'm going to try to nail this down in the next 20 minutes. I know some of you are still asking questions, but I'm not answering them. I capped it at the time when I started looking at the questions. I have to scroll down. I lost my place. Can I give advice on building a trade system? How many we need, and setting up rules for emotionless trading, please. Okay, emotionless trading comes by experience and getting bored with doing the same thing over again and not caring about what the result's going to be. Okay, if you go into the idea of trading a system based on very simple procedures, when will you trade? Well, Tuesday and Wednesday should be your trading days. What time of the day? We already know. London Open, New York Open. What are you aiming for? Start low end. Do a 15 pip target. Don't even do 20. Do 15 pips. There's your target. Okay, and if you do that, you don't need much of a system, and you don't need much of trading at all to do very well. You don't need very much at all. If you can average 15 pip return, and you're trading on Tuesday and Wednesday, and you're both profitable, okay, once it gets to 15 pips, if you can lock in that profit, okay, and allow it to go further, even if it comes back and stops you out at 15 pips each day, you've made 30 pips for the day. You've made your quota to double your money every single year. I can give you a million different trading systems, but it's not going to be the answer for you, because as soon as you start messing around with it, you're going to have new experiences in the marketplace using it, and you're going to graduate to something else. Something else is going to draw your attention, and that's all part of it. So that's why it's not answered by me giving you a system. It's not going to fix it for you. Okay, there's a vacuum of understanding that every one of you guys have, and only when you get in there and start doing these types of things and discovering who you are as a trader. I don't know who you are. I don't know what you're going to do with your money. I don't know. No one else knows that. No one can build a perfect trading system for you. You do that. Okay. Um, Asian currency pairs breakdown for the central bank dealers range. Okay. We will discuss that in a different teaching, because I mean, if I get into that, it'll open up a million things for me, and it'll be hard for me to keep track of where we're at. But I'll just say this: the central bank dealers range, as it's been taught, is very influential for trading the yen, Aussie, and Kiwi by itself. So treat that like your uh, midnight candle for London and Euro currencies. And I'll just leave it at there. You study it like that, and you'll come away with a great understanding. And when we get to actually teaching about it, you'll know right away what you should be doing with it. Do the algos use fixed pip ranges for different profiles? Um, David, I believe you're asking something that is going to be answered for you this coming weekend, but I will tell you this. Much like we taught with sweeping on the stops, they do it in 10 and 20 pip gradients, where they'll move beyond a high 10 or 20 points or pips, and below a low by 10 or 20 pips. Okay, those types of things are repeating generic phenomenon. Okay, and the things that we will build on and build a greater understanding and precision, you'll see that they are same types of things. They do the same thing. Think about it. An algo is a program. Okay, it's generated by rule-based ideas. It's only going to do what it's been told to work within. Okay, it's not artificial intelligence. It's not learning. Okay, it's not, oh, okay, well, it's going to do this and it's going to do that. They do the same thing all the time. What changes is the volatility filters that you'll learn. Okay, which makes the templates, okay, they are more accurate when you apply the volatility filters that's necessary. And the volatility filters are just basically, I can tell you in two sentences. Um, are we expecting a large range day? Okay, and or are we already in a large range environment? So certain profiles and certain templates will be applicable and highly accurate given certain volatility environments. And there's rules that go along with that. And based on that understanding, you'll be able to go in and say, okay, this is what we should see. This is what should and should transpire in market action. And this is where I believe the market is going to go. So therefore, I'm going to look for this to occur this time of day. This is where the signal is going to most likely form. I'm going to put my order here, or I will trade here. My stop will be here. I will stick to this plan. I'll hold to London close, or I'll hold to New York open based on the template that's being used. And then I'll move to the sideline, and then I'll wait for the market to close, and then I'll reassess everything and see how well I did. And you do that all the time, every single time you take a trade. And eventually, over time, you completely desensitize yourself. There is no emotion. You feel good because you keep doing the same thing, and it's positive. But you don't get excited. You don't get, you know, nuts about, what you're doing. You don't care about, how much you're making. You're just doing the same thing over again and getting the consistent response that you would expect as a consistent trader. Wow. If you guys are questioning me still, stop, because I'm not gonna, you're making it harder for me to track where I'm at on Twitter. Let's see. I messed up by saying no limit on time today. You guys are holding me to that one. The day I say I'm not going to have a limit, I'm actually having a limit. And usually I will just go on and on. And the reason why I'm only trying to put a limit on it today, because I've already had to keep my kids from busting through the door, and my dog, I've had to let her out twice now, so I'm sticking to my unprofessionalism. Uh, where are we at? I'm lost on this Twitter feed. Okay, Eugene. Yes, Mondays are typically the hardest trading day, and that's why I try to avoid most of them. Um, the only time I like to really trade Mondays is if there's going to be a FOMC on a Wednesday or a Thursday or later in the week. If there's an interest rate announcement that's going to happen in the middle or later in the week, Mondays will typically be a very good trading day then. But generally, they are a I don't know how to describe it. It's like a setup day. In other words, you just sit and watch and see what Monday's presenting, and creates like a extension of the central bank dealers range and the flout, those types of ideas. I treat Monday like that, and I look for orders to build up around the range that's created on Monday. Um, does London open kill zone being 7 GMT or 7 a.m. UK time this weekend? UK switched from GMT to BST. Um, this is a topic that I absolutely cringe when you guys ask me about. When it relates to time, um, that's why I've made it very easy for myself, and I believe it's easy for you too. If you just simply get a clock, I don't care if it's a wristwatch or if it's something on your iPhone or your desk, wherever you're at when you're doing trading, know what time it is in New York. If you know what time it is in New York, you know exactly what I'm interpreting in terms of price. The time windows that I'm looking at is as early as 1 o'clock in the morning to 5 in the morning, New York time. That's the London open kill zone, the extended. Okay, the sweet spots are 2 o'clock in the morning to 4 o'clock in the morning, my time in New York. That's the best time to see the higher low form in London. New York open kill zone in New York time is 7 in the morning to around 9:30 in the morning, as late as 10 in the morning. But I don't like it that late. I like to have it generally between 7 o'clock and 9 o'clock in the morning. And you'll see that generally it's between um, uh, 8 and 9 o'clock. That's usually when you'll see the actual signal form. It's because the news embargoes lift around that time. In London, close is 10 o'clock in the morning, New York time, to noon, New York time. If you stick to that, you can't go wrong. Um, my central bank dealers range from 18 GMT to 0 GMT, and flout is 21 GMT to 5 GMT. My question is, which tool is more accurate? Well, the the tools are close in some ways, but there's output that gives a trader something that one will do and one won't do. And again, that's all future teaching. But I'm giving you it in graduated pieces so that way you can spend time with it, do some analysis with it, see what you see on your charts. Because I want you to discover. Here's what I want to. This is what I'm hoping to see, and it's probably unrealistic expectation on mine, but nonetheless, this is what I was hoping I would see. By laying the breadcrumbs out there, okay, I'm not trying to be a dick and say, okay, make you work for it. Okay, I'm trying to see if you had the same experience I had, and you may not all of you may not be like this, but a few of you, I'm hoping was going to be able to say, okay, I see this. This is what I see, and I'd say, okay, yeah, that's it. A lot of you do that. They'll send an email to me. Is this something that's of merit? And sometimes I'll smile and won't respond because you're really close to it, and then some of you are way off, and I won't respond to it. Okay, but when there's times when you're on it, if I send you a smiley face, you're on track. Okay, but that's not an invitation. I probably just messed myself up getting 1,000 emails now, but I'm expecting to see some of you to see the realization in price action that I had when I had some of these things shown to me. And once I had a few things just dropped in my lap, it was just like all these tumblers came perfectly turning, and I knew exactly what I wanted to do as a trader. And here's the thing, the real rub is, I don't believe if I never would have met these two guys, okay, if they never would have reached out to me, I honestly don't believe I would be the trader I am today, because I was struggling with knowing what I wanted to do, and I was still making money. I was changing my stuff all the time, and I was evolving as a trader. Gate Trader, one of the guys that started with me way back in the late 90s, um, he can attest to that. I mean, I was trading things and creating systems all the time. I had a trading system called Super Mad Cow. How's that for a trading system name? Super Mad Cow. And I traded that system with probably 20 different tweaks to it. And while it was really profitable, it was changed about 20 times. About 20 times I think I made changes to it. And they weren't subtle changes. I mean, they were pretty significant changes. And my point in this is I know what it's like for you guys. Even if you are making money, you know there's something else you need. Okay. And once I had all this information, I stopped that chasing stuff. I just put it away because everything I was struggling to feel confident in and comfortable in, which was when should I not trade? Well, these tools do that for me. It tells me when I should not be trading. Because as far as trading goes, I was never afraid of trading. I was always trading. I was in there all the time. If markets were trading in the trading hours, I was in there. And it was in markets I had no business in. I was trading oats 6 times a day. Oats. That's one of the that's one of the thinnest grain markets there is. But here I was in there trying to trade everything I could. Okay, just because I had a trade system and a platform that allowed me to see what it was doing intraday, and I had no business doing that. So the reason why I do a lot of the graduated teaching is number one, I want to control the flow of the information, and yes, I monitor who's teaching my stuff, and I build a long, drawn out timeline because I don't want anyone else to be able to say they did this stuff before me. Because if they did, they'd have it out there, and they don't. And by me stretching out over a long period of time, there's a large audience of that I've done certain things in certain years, and you guys know it. So when someone comes along and I smack them upside their head and saying they're full of shit, then there's justification for it because they really are ripping me off. But I'm hoping that some of you will say, hey, look, this is what I'm seeing. And then you'll know, believe me, it'll be the long-winded emails that, you can't sleep because now you know this and that. That's the experience I had. I could not rest because I knew tomorrow there was so much opportunity available that I couldn't bring myself to rest to get ready for my job. That's when you know you got it. Because I was working 13 hours a day when I first started learning this stuff. And when I was starting to make $1,000 a day, it's real hard to do a job when you're making $235 to bring home a week. It's real hard to do that. You think you hate your job now. Think like that, okay? Because I was doing month after month of doing that. And I was only trading one contract of the bonds. One contract, that's all I was trading. And I'm doing $1,000, every time I went in there, I was making $1,000 a day. And I'm like, wow, man, this is incredible. And I didn't want to do anything with my job anymore. I didn't want to do any market research because I was a vendor. I filled soda machines and snack machines, and I did that for a career. I wanted to have my own route. I wanted to build my own business up, and that shit went right out the window when you start making that kind of money. You don't want to deal with anybody. You don't want to deal with customers. You don't want to deal with trucks and repairs and people breaking into the machines and stealing the money, and then you got to go buy more inventory and part. You don't want to do all that stuff, and it was very hard for me to relax because I knew I wasn't doing that shit long. I was getting the hell out of there. I did not want to work. I couldn't stand reporting for somebody. And where I worked at and where I lived at, I had a 45-minute commute one way, and that's when I was speeding. Okay, so I hated it. I literally hated it. Majority of my day was all work and commute, and I couldn't tolerate it. So I'm telling you, I know what it's like for you to feel what you're feeling, but you'll know when you got it when all of your time is being spent in your development of what you're actually going to trade your money with. Not chasing dreams. It's totally different. Being excited and listening to a inspirational video or a rant, that's totally different to when you see what you need to be doing. And it's going to happen for all of you if you give yourself the time to submit to your development. You're going to see things in your study that's going to click and you say, that's the type of trade I want to trade. That's the one I want. I want to see this. I can see it happen. I've seen this thing happen 30 times in the last 4 months. I know I can trade that setup. I understand that setup. I don't know his other London close stuff. I don't know his New York Open setup, okay? But I know this. I can see it in the chart, and this makes sense to me. And that's your trade. That may not be a trade I ever take. I may not even see it in the chart when it happens. I'm not even paying attention to it. But that's your career. That's where you build your career as a trader. And you develop that, and you cultivate it, and you build it up, and you get real confident with it. You don't chase anything else. You don't add anything to it, and you live there. When it loses, you accept that. When it wins, you continuously milk it. Eventually, you will not have any tolerance for your job. You won't. And you'll know when you're ready to leave it because you'll have enough money to support yourself for 2 years. 2 years of living expense. And a respectable amount of money. I don't think anything less than $50,000 and 2 years living expenses. Anything less than that, I think you're selling yourself short, because regardless of what you might believe, when you get in there and you're really only trading for your income, shit gets real then. You get really, really nervous. Even if this stuff's been consistent, you can't relax because you're like, man, I hope this trade pans out. I know I should be holding for this level and this time of day, but man, it's hard for me to do it. You're going to be looking at the chart more than you do now. You're going to be worrying about it all the time because now your livelihood rests on it. So now imagine if you got 2 years living experience, I'm sorry, living expense, in the experience of having done it for a while and being consistently profitable, then you're really equipped. I mean, because you can be wrong for a period of drawdown, and you're going to be able to live. You got 2 years living expenses, 2 years living expenses, and $50,000 minimum. I think that's the minimum. Preferably, I would say $100,000, $100,000 and 2 years living expenses. And I'm not talking minimum expenses. I'm talking about where you're comfortable. Anything that might be foreseeable. Car expenses, vacations, all that stuff. Now, don't sell yourself short. Don't be in such a rush to leave your job that you put yourself in such a tiny little window of opportunity that what could be done easily with a little bit more time waiting, you now make it an impossibility. Okay, and given an opportunity to go back in time, I wish I would have done a little bit longer of a wait. I rushed, but you know, when you got $832,000, it's real hard to go to work for less than $250. It just doesn't work well. The math isn't there, and you just say what I just said. I can tell you, I was sitting on the floor with my girlfriend at the time, and I didn't marry this woman, but I was dating this girl, and I was laying there in the middle of her living room floor. I spent the night with her, and without being too graphic, I didn't want to leave, and I just paged the boss I worked for, and his name was Glenn Hyatt, and he called me back and he said, "Are you coming in?" I said, "No, sir, and you can keep my paycheck. I'm not coming back at all. I'm done, and I appreciate what you've done for me, but I just can't do this anymore." And he said, "You can't do that." I said, "I just did, and I don't want to make it mean, but I got to go," and that was it. He never mailed me my check. I never asked for it. I sent him an email for my W-2. That was the last response I gave him, and he mailed the W-2 that I had to use for taxation purposes, and that was it. That was November 19th. I can tell you the day. It was 9:35 in the morning. I can remember the sun shining right through the shades of her living room, and I'm telling you, that day I knew I was done. I could not bring myself to go in, and that'll happen for you. But I wish I would have waited a little bit longer. I think that was a really shitty way of doing it. I could have been a lot more respectable in the way I left it. But I was new money back then, and when you got that kind of money and you're making $17,000 a week, it's really, really hard to hear anybody else's opinion about what you should be doing. And money absolutely does change you, because well, first of all, I wouldn't be able to talk to you like I'm talking now. I mean, I was very shy. I questioned myself about a lot of things, but now I ain't worried. I can stand in front of anybody and tell them whatever I want to tell them, and not worry about what their response is. You can call it arrogance, you can call it confidence, whatever it is. That's just, it's molded me into that. But I went through that ugly period, okay, and trust me, you'll have it too. As much as you all will tell you, I ain't gonna be like that. You friggin' will. Trust me, you're going to. Life instances, we're gonna they'll present it. Okay, you're going to be tested. You're going to see how you're going to react. People are going to challenge your character and your sense of who you are. And when you have a lot of money, believe me, I know from personal experience, it does change you, and you will have a different view on things when you get it. But don't rush to get out and leave your job, because the worst thing you can do is leave your job and blow it because you're rushing to make money, because you got 2 years or whatever it is that you had saved up to live on. If you sell yourself short, you're not going to do well in this. I promise you. You have to have a long-term plan, and I believe 2 years money, living expenses saved up, and minimum $50,000 a year saved, preferably $100,000. That, I believe, is a good, sound starting point. And I think that if that's what you're trying to do, if that's your goal, if you're going to ask me what I would think is a realistic plan, that's it. Okay, and then graduate out of your job. Let your employer know, well in advance. Don't be an asshole about it. Like I literally, I couldn't have done a worse way than that. I mean, the guy couldn't operate his business if they relied on me, and I just left him out there. So, one thing I wish I could go back in time and change, but nonetheless, it is what it is. Uh, Larry Williams came up with the idea of seasonal tendencies. Well, he's the first person that wrote about it. I don't know if he came up with seasonality. I think that's his influence itself, but I think he's the first one, and no one out there been able to say otherwise. But he's the first person to talk about it as it relates to trading. Um, I do believe we're winding down here. Nelson, considering all the information that I shared to date, what's the list of things I look for on a day-to-day basis in order of significance? I think I talked generally without having seen this question. I kind of like talked about it today. Break it down what I believe the dollar is going to do, and if there's going to be a cross that will influence those currency pairs that you trade, you start there after looking at the dollar index. I like to look at times of the year, obviously, for things to unfold. Um, we're in a time period where the British pound should be rallying, and if it's designed to go higher seasonality wise, uh, it's not hard to expect weakness in the dollar. And you can see that happening here on the daily chart. So everything I've talked about here and other places, but largely if you spend time on the trading plan development, that thing goes into great detail. I mean, that's like overkill on what I do, but that's what I do, and I do it very quickly because I know it like the back of my hand. It's the routine I go through all the time. 90% of my trades have SMT diversions. How does this fit into intraday London Open and New York Open, or is it only used for directional bias? It is used for directional bias and trade selection. It is a qualifying tool, but it can be complementary for timing. So if I see SMT diversions um, in a larger term setup, in other words, higher time frame premises suggesting higher cable, you can look at SMT divergence between the dollar and cable, and or SMT divergence between euro and cable. So you have correlated pair SMT and or USDX SMT divergence to use. But SMT is, to me, once you understand what I do, you don't necessarily have to go into to see that to qualify the setup. Many times you're going to go back and say, "Oh, it was there," but you didn't see it at the time because you were referencing other things in trading, the order block or the range it traded into, or liquidity pool when it took out stops. Those things are going to be paramount over that. But SMT, it's just going to be a signature to a really well placed trade. When is day trading with a directional bias article coming? When I decide how much to sell it for. No, I'm just kidding. Honestly, I've so much on my plate. I do this to myself every year. I say what I'm going to do, and I'm excited about sharing it. But honestly, um, everything that I would put in that article or that PDF file on the website, you already know it. I'm not going to say anything outside of what I already said. I mean, it's just a matter of just putting it in a PDF format. So I don't know when I'm going to do it. Actually, I probably should remove the link so folks would stop telling me it's broken. Mike, sometimes I hate Mike. By the way, if you ever say my name as Mike, I'm going to drive to your house and give you a one-on-one session you ain't going to like. I hate Mike. Michael or ICT is fine, but I cannot stand being called Mike. It drives me nuts. I think Mike the mechanic. I think of that all the time. But nonetheless, the question is, sometimes you say price should not come back to here. Is there something that makes those order blocks different? I believe I gave an example of this when we were talking about the dollar here. I believe that this low here should be keeping price above it, and it's also the mean threshold of this candle here. So that's the reason why I said it should not go below this low. Now, obviously, if we have reasons to suspect the market going higher, bullish order blocks should be respected to the left of it. And if they start breaking down, that's not a telltale sign of underlying accumulation. That's going to be either a consolidation or a breakdown in distribution. So that's why I select those types of things and say that. Could we have a overview of what's your standard routine on a monthly basis, quarterly, and evenly, eventually yearly? Um, well, for me to be able to help you pay for the live event that Chris Laurie and I are actually putting together for spring of next year, I'll have to do that, won't I? So to be able to make you guys trust putting money behind some of the ideas, I'm going to make it very heavily documented so that way you can feel confident about it. I already know 80% of you just want to see the trades and make money on it, and you have no interest of getting on an airplane flying to Baltimore. I know that. Okay, I don't care. I don't care if you come. I don't care if you show up or not. But I know some of you will, and if you learn anything from this, great. Then it was a success. If you make money and you use it to capitalize the trip and the expenses being over here, then great. You'll learn something that I'm not going to share on my website or YouTube or in these live sessions, but it'll be a unique experience. But leading up to that, to make you feel comfortable, I have to use all the things I teach to show the validity behind it because it's going to be a different environment. Obviously, it's not like me just demonstrating, it's going to be actually me doing the work. So I got to come up with a way of doing it where it doesn't break my routine and throw me out of whack because I generally don't talk about what I'm doing. I just get in there and do it, and there it is. And like I said, if I'm over analytical about certain things, it will weigh on my psyche as a trader, and I don't like that. So I got to come up with a delivery method that meets a criteria that helps. So I'll kill two birds with one stone. You'll be able to see what I'm doing with my money, and I'm gonna I got a planned um, approach that I'm formulating, and I'm waiting on Chris to get back to me about some of the things he wants to do. And once we establish that, there'll be more information about what it is that we do. But I only need really 6 months to make sure you guys can make salary. About $7,500, I think, is a fair. The highest one I saw was $5,000. So I'm building in some expenses for eating and things that you have to do while you're here. So I think $7,500 for anyone that's willing to go along the process. You'll be more than equipped to be able to come and join us on that venue. So as far as the indicator working with Mac, I have no experience working with Mac or their operating system, so I'm at a loss as to be able to answer that question for you. Gringe Cat or Gringer Cat. I'm not sure if that's how I pronounce it. Um, what's my favorite book about psychological side of trading? Trading in Zone and the alcoholic's perspective from Trading for a Living from Alexander Elder's book. I believe he's done a really good job. I can see a lot of the things he was saying in that book because I grew up in an alcoholic environment. A lot of my family members were drug and alcohol users, so I've seen the devastating effects of that. That's the reason why I don't drink. I've never drank alcohol in my life, and I never smoked drugs or taken any kind of medication that would alter my state of mind. Um, but I think that Trading in Zone is good, and I like the presentation that Chris Laurie did for psychology in trading. I think it's really good. I think it's, in my opinion, I think it's better than Trading in Zone and Alexander Elder because he really puts it in points that it's palatable. I mean, you can at least it was for me. I think it resonated well with me, and every time that someone asks me a psychological question as it relates to references and such, I always say go to that one, buy it. I mean, it's not that much money, but it's really good. Um, oh, I read that question out of line. You guys snuck that in there late. I lost my position on Twitter. It scrolled up. Um, see if I can close this thing down in 9 minutes. How do I keep balance? Ian Jones is asking. How do you keep a balance between trading and maintaining relationships with family and friends? Well, I can tell you, while I was making that money initially, with luck, even though I felt like I was working my ass off, and I was. I mean, I was looking at charts and going crazy with all kinds of things. I had trend lines all over those freaking things. None of them worked, but nonetheless, I had trend lines all over them. But I did not have a really good social life at that time. I stopped dating. I wasn't worrying about working out anymore, and I had a pretty good physique at the time when I first started. But that all went to shit. All I was worried about was trading and getting to work and coming home and getting those charts again and buying books and reading and buying books and reading and buying books. And I just basically sheltered myself in my aunt's bedroom that I rented, and I did not do anything except for those things. And I was not like Larry Williams. It's really, that's why I sent that video out, because a lot of what he described, how he was operating in 1987 when he won that contest, that's how it was for me. My first 18 months of trading, um, it was it was crazy. It was crazy how I didn't want to do anything else. My family members never saw me. Even around the holidays, I'd come down briefly. Hi, how you doing? And they would talk to me. And the only thing I can think of is, what's the current reading on sentiment in the commercials on soybeans? That's how I could see their lips flapping, but the only thing I can think of is, what the hell's going on in the grain market right now? Because I was killing it in the grains. So that's that's what I was plagued with. So eventually, when I was able to push it up where I didn't have to work anymore, I was able to relax a lot more. But I can tell you, it's very hard. It's very, very hard to balance family. It's the market. I've said this before. It's a very cruel lover. It's very demanding of your time, and even when you're not around it, it owns mental real estate. You're always thinking about it. Okay, I mean, think about it. Now you're not trading. You're listening to me yap and go, gab on about shit that probably doesn't mean anything to you. But it's a cruel lever. Even if you aren't around it, you're going to be thinking about it. If you're not trading on the weekends, you're thinking about it. You're not worried about what your kids' baseball games results are. I can tell you, even still to this day, when I watch my kids play basketball, my littlest one, he's in basketball. When I'm watching my 11-year-old play soccer, he's really, really good at it. I can still very easily drift off into, what's the market going to do with this coming up in the week, or what do you think's going to happen? My wife, she knows when I'm zoning out. She'll look at me. She's like, "You're not even listening to me," and it's bad. I mean, it's bad. It's bad of me to do that. I'm not trying to say this is something you should be doing, but as a trader, because it's so I don't know how to. It's consuming. It's very consuming because it requires a great deal of focus. It's like I said earlier in this presentation. There's nothing else like this on Earth. There's nothing like it because it's you, and 100% you. You get all the credit and you get all the flack when the shit goes to hell. So when you have, the results all on your back, there's no one. Believe me, you're worse. You're worse than any boss could be, and you're rushing. Think about it. You're rushing to get out of your job that you already know the limitations are in. You know when you're going to go to work. You know when you're going to go home. Okay, so those are they're finite. Okay, but you have infinite variables when now you're the boss. You're trading, and you only get paid when you do shit right. If you ain't got it right, you ain't getting paid. In fact, you're losing money. How many times have you lost money going to work every day? It don't work, right? I mean, you get paid. You get paid for exchange for time. That doesn't work in trading. And every one of you guys and gals are probably in a rush. Man, I can't wait till I trade for a living. The hell you can't. Okay, believe me, you can wait because it's a total different world. Because you think it's hard for you to balance shit now. Wait till your whole livelihood rests on it. That's the real story about trading. No one gives that kind of perspective unless I mean, a real trader when he gives it bare bones to you like that. Everyone thinks it's all rock and roll and lifestyle of the rich and famous. Like this show Billions. I don't know if you guys have watched it recently, but I think I'm halfway through it. I'm getting caught up. I love the show. I think it's great. I love the cat and mouse between the two guys, but it's not all sitting back like a rock star buying yachts and drinking $800 chocolate flavored scotch. Okay, that's not how it works. Okay, these guys are shitting themselves and pissing the bed. Okay, when this stuff's bad, you don't see that. And as good as your trading's going to be, eventually you're going to have periods where you're not making money. and it's going to be a problem for you if you're not prepared for it. So imagine now your whole entire uh, living expenses are derived from what you're doing. And now on top of it, you're married or you have a spouse, that is rather interested because you no longer go to a time clock anymore. What are you doing with your time? Okay, there's a whole level of, well, if I got to go to work and you sit home on these computers play video games, because that's what was given to me when I first got married. My wife, it was very hard for my wife to understand what I did to get the money that we have. It took a long time to find it. She gave it up. She's like, I don't understand how it works. Just, I don't want to know about it. So long and short of it is when you have a spouse, you're not in business alone. You're in business together. Whether she's taking a trade or not with you, she is, or he is. And it's going to be a very difficult thing to balance because how do you justify your home if they have a job and you're still building up that position where they can eventually quit their job? You see, there's a lot of balancing that goes into this that most people don't take into account for. But when you know you're talking to a real trader and they've done this stuff and they know what it's like, I like those stories. That's why there's this the guy does those chat with traders. I love that. I think that's an amazing idea because it's kind of like Market Wizards, you know, um, in continuation. You have all these um, lives that are being affected by trading, and some of them are good and some of them are bad. But nonetheless, it's interesting to me. I like that. I like listening to other people, how they engage, what they do with themselves. I don't care how they trade. I really don't give a shit about what they're doing to make new trades or whether they're, how much they made last week. I don't care about that. I like how they engage the career as a trader because you're the hardest boss you'd ever have when you're on your own. You may not think it, but when you start trading for yourself, shit, let me tell you, when you're late to the screen and you miss the opportunity, believe me, your boss will ream you out and give you a write up, and it's the end of it there. You're not living it down as a trader. You're living that shit for a week, next week, last month. I mean, the next month you'll be thinking about what you didn't do right the previous month. Think about it. And you're all in a rush to get to that. You don't even know what you're looking for. Believe me, you have no idea. Everything changes when you're trading for a living. So, balancing things now and getting used to it now should be one of the things that is part of your development. Think about what it would be like if the profits that you're making and the losses that you're occurring, what you'd be doing, uh, you know, if that was your income only. It changes things. It changes things a great deal. And having that, in your mind now, it's very sobering, and it'll help stave off that impulse to want to be in a rush to quit your job. But believe me, that money's guaranteed as long as you have a job. As long as you show up for work and do what you're supposed to do, the paycheck will come. It doesn't work like that with charts. Okay, just because you sit your ass down in front of the computer and the screens, okay, and you draw your analysis in rectangles and order blocks on here, it does not mean money's falling out of outer space right into your forex account. It doesn't work like that. I've tried very hard to make it work like that, but my shit never works like that. So you know, you have to have things line up. It's not just being at the right place at the right time at your job, and therefore you're going to get a paycheck and taxes get taken out, and that's the worst of it. You have to view being absolutely correct and doing the same thing over and over again so that way you're not being pulled emotionally, okay? Because there's going to be a great deal of things that you don't even know about right now that you haven't experienced yet that's going to be a huge, huge impact on how you are as a trader. And I can't teach that to you. No one can teach that to you. It's all going to be experiential. And again, that's one of the things that makes this thing the hardest thing to do. It's the easiest thing on earth to do, but try doing it. It's hard as hell. It's difficult, really, really hard, because you have to consistently do the same thing over again, regardless of the output. Regardless of how many times your wife says, "Well, didn't I tell you you should have got out of that friggin' trade last week? You said you weren't going to hold the trade over the weekend. Here it is. You're pissing and moaning. You're angry. You got an attitude. You don't even want to come to the table. You don't want to look at me. You want to talk to me because I know you should have did this and you didn't do it, and now you know it's going to come out of my mouth. And here it is. I told you so." I'm telling you guys, believe me, you're going to be the hardest boss you ever would ever work for. So please understand what you're getting ready to get involved in. If you want to trade for a living, that's what you got. It's not yachts and chocolate covered cherries and sitting back on the beach and all that other stuff. Believe me, being affluent still brings with it a great deal of bullshit. Okay, there's stuff that comes, and you're gonna experience it. Trust me. Money doesn't remove all that stuff. Your family still has things that's going to contribute, and it's going to be stressful. It's going to be you're going to have setups that require your attention, and you're going to have family events that are going to happen at the same time, and you're going to have to weigh, what do I do? And you should be doing the family thing. And unfortunately, I can tell you in honesty, I've done the opposite, and I regretted it. And I got God smacked a lot of times. Okay, I didn't have a profitable outcome in that, and I lost on both fronts. I lost the opportunity of seeing something that should have been very, um, I guess, momentous, as a father. And I chose to chase the dollar bill, and I didn't even get that. And I got a really disgruntled spouse, and my son was disappointed in me. And these are all things I wish I could go back and change. But you're going to have all these experiences as well, and you can't prepare for them except for know that they're going to be things that you're going to have to deal with, and how you react to them is going to be a response that's going to affect you as a trader, and it's going to shape you. But I can't give you the balancing points. When I got the best balances when I uh, became a Christian, and I'm not a poster boy of it. Trust me, I'm not. I don't claim to be. I don't preach it hard and heavy, but I got grounded with that, and that helped a lot. Um, but I think that's enough for that one. But the um, can I share the flout range indicator? I did that. I already shared that. I showed you yesterday where to get it from on Forex Factory and how to develop the template with you with MT4. And the information about why 12 to 12:30 is specifically important is because 12 in midnight in New York time starts a new day, and the initial move after midnight is important. So you have to monitor that range. Whatever that happens in that short little span of time, price will many times come back up to it, kind of like an Asian range retest, or an order block. It has a very similar effect. Okay, but if you're bullish or bearish, that area is very sensitive. When am I going to do my first Periscope? I don't believe I'm going to be doing any of that soon, but I might do my very first Periscope from the live presentation next spring. I think that would be cool. Here we are. Nah, just kidding. Um, what effect does the flout and dealers in Asian range have on New York Open trades other than re-entry at those levels if London Open is missed? It's highly uh, influencing your London Open trades. It's predominantly set up for that. But once it's established, it's just a matter of what has happened in London sets the tone for the New York session, much like everything else I've already shared. So really, it's just highly correlated to the London Open setup. It can come back and trade into those levels during New York and give you an additional setup, but I don't see that happen enough to be making a big case about it. Um, you show all, but when we see your join in point to trade always different than you show, can I explain my trades? Okay, I guess what your question is some of my trades don't look like some of the things I teach. Okay, there's and I kind of been trying to show you this in recent live sessions. You don't need the absolute entry perfectly at the order block if you're inside a higher time frame directional price swing and you have plenty of range left in the day or the week. So if you have a setup and it trades at a range that's close to the order block and it allows you a favorable stop loss, why would you not want to take the trade? So I need that's something that you need to. Even though I preach hard and fast that precision, 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 the precision just nails down low risk entry, but you can still take moderate and tolerable risk entry and it be hinged on the framework that was established using the tools. And I showed an example of that in the cable here today. You don't have to have the absolute entry. You don't have to have the absolute uh, best case scenario entry point, as long as you have the room in which the market is going to potentially move to. That's the most important thing. The entry's not the important thing. Everyone gets this big thing about show me where to get in at. I need to know where to get in at, because that matters so much to you now, because you want to over leverage. You want to put more on the trade than you physically should. So if you have more time worrying about where it's ultimately going to go, okay, use that as the basis point of why you're even doing this. Where is it going? That's where you should be thinking. Where's the market going? Not where should I get in at? See, there's a difference in there. Retail thinks where should I get in at? Buying or selling, it doesn't matter. Retail thought process is where should I get in at? Smart money is where's the market going? That's where the money's at. It's not. Think about it. I can tell you 50 different ways to buy and sell, and I have in the past. But I could sit down with a one-on-one. This is a million of you are asking right now, because I've talked about doing a live session. They're all asking, can I have time with you individually? The answer is no. Okay, I don't mean that to be mean or rude, but I just can't do that, guys. I mean, everybody wants to have that, and I don't have any interest in it. So the best thing is for me to do groups, and I think, you know, what is being put together is it's a good way of doing it. It'll be, you won't have anything to weigh it against, because it's going to be unique in itself. But when you have, the idea of sitting down and asking yourself the question of where's the market going, okay, that opens up a whole different uh, understanding, and also motivation. What is it then? Now, all of a sudden, now, if you know you're asking that question predominantly and not when should I get in at, because think about it, you're chasing money with that question versus understanding the market with the other question. Where's the market being drawn to? Where's the market heading? If you have that as the basis of where you're trying to trade off of, not where should I get in at, and heavily worrying about entry points, weighing your entry price against mine or someone else's that's in the group, that's the wrong perspective. That's not what you should be doing. The trader that has longevity, okay, and consistency, they worry about, and this is a true statement, they worry about where the market's most likely heading or where it's going to reach for. And I preach that. It's nothing new. But think about what happens in your own mindset. You're worrying about getting in. I need to get in. I need to get in at the right spot. Why? What if you cut the leverage down to 1/4 of what you want to trade with, and open your stop off up to 100 pips? Does your entry matter then? Hell no. Not if you know where the market's heading. If you ultimately have a solid understanding of where the market is heading ultimately, 2, 3, 400 pips from where it's at right now, a 100 pip stop loss doesn't mean anything then. But it means a whole lot for your entries if you want to use a 10 pip and 15 pip and 20 pip stop loss, or even a 30 pip stop loss. Because now you got to be highly selective and really precise to get in there. Think about that. That's a mind shift that you have to allow yourself to go through. Don't be demanding precise, perfect entries all the time. Know what it looks like. Know what that looks like, because if you go into the marketplace and you see that happened in hindsight, and you're recently just coming away from that same level, you're saying that's not a good trade, that's not a good entry, that's not a solid setup. Why wouldn't it be? If you know ultimately where it's going to go in respect to where you're thinking it is right now, and the setup is missed, but you have a relatively decent entry from where you're at right now, and no, you're not trading right at the order block. No, you're not. But you still have range, and the stop is favorable in terms of what you expect to make in the trade. So why is that any different? You see, I teach the concept if you're sitting right in front of the chart at the time, but you're not going to get that all the time. I don't. I'm sitting here talking to you right now. Some of you are at your jobs right now. You're at your work, okay, or maybe you're commuting. Some of you are sitting home and you don't have a job and you're listening to this, okay. But I'm sitting here literally. I'm going to give you a too much information scenario. I'm sitting here with cozy socks on, okay, a pair of underwear, and a t-shirt, and I'm sitting here with my dog next to me. Okay, that's the ICT image I want you to have right now. I don't care what anybody else thinks about my trades. I don't care because my trades put me in a situation where I can do this today. I'm not getting dressed in a shirt and tie or in a jumpsuit running around filling up candy machines, and I'm not slapping pizzas, and I'm not delivering pizzas, and I'm not doing any of that stuff. I'm not reporting to anyone today except for you guys, and I'm doing it for free. So I'm making my own schedule, doing what I want to do because I worry about where the market's going, not where I'm getting in at. I know I'm going to make money. I know I'm going to make money. I just don't know what day or time it's going to happen. And I submit to that. I submit the time. I know in the course of Sunday's open and Friday's close, I will do more than I ever would need to live off of. You ain't going to get that unless you see this stuff occur over a long period of time. So grading my entry and grading my specific um, level of entry, I guess I'm harping on here, is yes, I do not always get that absolute entry point because lately I told you I'm not using limit orders. I'm going into market because there's a lot of things I don't trust in current market action. I just don't trust it. So I want to see certain things that take place, and when I see it, it's basically I'm all in there and I'm going into market. So when the markets, if they ever do at all, if they settle down a little bit, then I will go back to my old way of doing it, and trust that I can put a limit order in. Because I don't want to do this. I don't want to get up and before Frankfurt, establish an idea, put the stop loss order on with a OCO, and basically have my order set up where it's autopilot. If it trades to a level, it goes in with a limit order, sells or buys based on that. When that order becomes active, it opens up a limit order for profit and a stop loss order for uh, limiting my loss. The worst feeling I hate is waking up, seeing I had the market right, my stop loss gets ran, and then it runs 150 points, and it pisses me off. I don't like that. So I'm willing to let them go for sleep and be up when I want to take the trade because I already know what I can do with myself as a trader. I can be fine with that. I really long for that environment to come back. I want to be able to do that again, but until I can feel confident and do it again, I'm doing this. And I ain't got to worry about it. So anyway, I think 700% a month return when you really want to work for it is uh, is evidence enough. I don't need to. You don't need to do very much when you can do that. So, and if you can do, like I said, 6% a month, it doubles your money every single year. And if you start with $1,000, you young guys, okay, I know you're in a hurry. Y'all want to buy your Bentleys and your Verons and your Lamborghinis and such, and y'all want to put it on Instagram and live the life of a rock star. But trust me, um, you're not you're not going to get there doing what you're doing. Okay, but if you relax and settle down, and if you just scrape up $1,000, work the equity the way you should be, slowly, very, very gradually, focus on a 1.5% return a week. That's 6% a month. It's more than 6% a month, actually. It's like 6.5% compounded over the month. But that doubles the equity every single year. In 10 years, okay, without taxation incorporated, it's over $1 million. And you did it with $1,000. No one's going to just start with $1,000, especially if you're consistent. You're going to find money. Money will fall in your lap. It will find you. You ain't looking for it. Believe me, I got money offered to me on a daily basis. I don't want that. I got enough money to worry with, and it's my own. I don't want nobody else's money to worry about. But when you have the ability to do this, okay, and you can get 12% return, 20% return, and I know look, not anybody can come on the internet and talk about how consistently they can make 20% returns or 30% returns or 50% returns a month. Very few can actually do that. Okay, but skill sets like what we're teaching here, it's possible. I'm not guaranteeing you're going to do it, but it's possible. But how many of those months do you need out of a year to do very well? Think about it. What the hell are you getting in your return on bonds that you hold? Okay, or T bills. Like I own T bills. Son of a bitch and things ain't doing nothing for me. They're not doing nothing for me. And then all of a sudden, I play around in a retail account. I was talking to my sister the other day, and she was like, I have T bills right now, and they aren't moving around. They're not giving me anything. I was like, I know. I know I got tons of them, and I don't like them. They aren't doing anything for me, and I'm going to be bailing them out. So I don't want to have them any longer. But when you have a return as a trader and you can turn around a small amount of money like that, it's just laughable that people have savings accounts. I mean, think about it. Just as a think about if you have a savings account right now, regardless of what you have in the account, how much money is actually coming to you in the form of interest? It's laughable. It's crazy. Why why would you keep your money in a savings account? Take a quarter of that money and speculate with it, and you'll blow away what you would have over a 10-year period with what they're giving you in interest now. You have to slow yourself down in terms of your expectation. You have to get yourself prepared for a career, okay? And you hot shots that are young, okay? Most of you Bitcoin boys, okay? And I mean this. You're all trying to get there quick. And admittedly, I got here quick, way faster than I should have. But I also had a period of hell that I had to get through that would break you. And I mean that. It was very, very hard. And the only reason why I stuck through it was I could not accept the embarrassment of having shown everybody that knew me and my family members, okay, that I went to millionaire status and then down to negative $30,000. That's exactly what happened. And I had to climb up out of that. And once I did that, I don't ever worry about money anymore. I don't worry about it. It's not because I have lots of it now. It's because I came from really, really bad levels. I mean, I'm talking like depression, like I can't even put it into words. But I came from a point of which I had to have family members lend me money because I was negative 30 grand. That's how bad I hurt myself. And I knew how to trade one side of the market. I could only be a buyer, but it wasn't a buyer's market. It was the market in a bear market, and I was getting my ass handed to me, and I could not make it work. I was scared to short sell. Didn't understand it. So finally, after learning how to trade, um, it turned around, obviously. But then the ego came back and all that business. But you don't need a whole lot of money. You need time. And once you mature, and believe me, there's maturing in this. Once you mature and you understand that, you don't worry about what it's going to take for you to have to start with this. I mean, think about it. Okay, look at, for instance, the cocoa market. Okay, let's change the screen because you probably are going to be sending me, I'm watching a video, I'm hearing you talk, but the video's not changing. That's because I'm not changing it. I'm talking to you. But let's assume for a moment that we had that cocoa trade. It was a real trade. We hypothetically put $1,500 into call options, the 3,200 and 3,250 call options for July contract of cocoa. Dollar's down today, so we should see a little bit of appreciation in cocoa. And we have July cocoa up 0.3, not much. I was expecting a little bit more than that. But we did a paper trade, just hypothetical. Again, and everything I'm saying right now because it's commodities. We're all not in a position. I don't own a position. I don't have any call options. I'm just giving this an example because we had a member ask if the criteria that we talk about with open interest and such is seen in this. And we're going to close this presentation after I talk about this and be done. I went a little bit more than I wanted to. And if I didn't answer your question, I'll go through Twitter, and I know what I answered on here. So if it didn't get answered, I'll shoot you something through Twitter. Consolidation in here, open interest dumped heavily. Okay, so that's covering shorts by open interest dropping like that. Commercials are looking for sharply higher prices. The market went up to 31.50. Didn't get up here and close this range. Even where we're at right now, I am not saying that this thing is done. It's not going to, I don't think it's done. I think it's going to still go up, especially if we get that dollar movement down into this this low here. If we come down here and clear all that out, okay, we definitely will be seeing new highs in July contract on cocoa. But I'm not trying to, pump it up. I'm not trying to, build up a case for it because I'm not in it. I don't have any skin in the race. But if we look at what had happened in that commodity, we discussed where are we at? These options at the 3200 and 3250. The premium was 350 and 350 for the 3200 and $300 per call option on the 3250. They went up 270%. Now my question is this: I understand the majority of you listening to my voice right now are all interested in foreign exchange and forex only, and you're like, what the hell are you talking to me about cocoa for? Because you all are coming from different walks of life. I'm telling you, I started as a commodity trader. These are the markets I started with: lumber, copper, live hogs, feeder cattle, wheat, gold, silver, crude oil, heating oil, natural gas. These are all markets that I studied. I didn't understand the stock market, but I understood commodities. You don't need a whole lot of money if you're right in trading options. So my question is some of you guys, you're very open about what you're trading with. Some of you send your trades and what you made on your trades, and you're trading very, very, very modest amounts of money, a couple $100 here. Some of you are actually below $100. Okay, and I'm not trying to make fun of anybody. That's not what this is. Okay, I'm not trying to size up anyone. I'm just saying that I know some of you are highly sensitive about what you have right now, and you don't think it's ever going to work for you because you can't have any money. Some of you guys are from other countries that have very little money, okay, are asking questions like, hey, look, I want to do really well because I can't afford to trade my own money. I don't have much of it. So I know if I can get good, I'll trade other people's money. Yeah, you can. I don't have the stomach for that anymore. But yeah, you can make a great deal of living doing that. But you don't have to do that to do your own trades, to make your own money. For instance, look at we shown one example here. It just came on heels in the steam of someone else asking a question. If the open interest dropping down in here when it's consolidating, does that mean that the market's going to move up? Yes. And we applied all the open range here. The market traded up into 3150. It appreciated 270%. Now, my question is this: if you can find 2 or 3 of those conditions a year, okay? Now imagine, say you only had enough money to open up a trading account with like 2,500 bucks to options and trading account. Okay, so you have $2,500 to trade. You can do this with stock options too. It doesn't have to be commodities. But if you do 200 and 300% returns 2 to 3 times a year on your money, how long does it take for you to get to a reputable amount of money to trade with? And I don't know what that answer is for everyone. Every one of us is going to have something different. I've always asked that question in the beginning when I first meet people. What's a lot of money to you? It's amazing how much they'll say is a lot of money to them. And it's not that much money. Even before I made a lot of money, it wasn't that much money to me. What's a lot of money? I don't know. What's it mean to you? But when you have different ways to make money, okay, you don't fear money. You understand that money is a tool, and you'll be able to make money easily if you understand it like that. And there's different ways to trade and different ways to speculate, and it doesn't have to be foreign exchange. It doesn't have to be stocks. Okay, it can be commodity markets, and it doesn't have to be the actual contracts where you actually have to have a whole lot of margin and worry about being stopped out. With an option, there's no stop loss. The risk is your premium paid. I don't risk like when I first started learning how to trade options. I risked half the position that I paid the premium on. In other words, I paid $1,500 for the orange juice option, and had a stop loss at 750. And guess what? At 750, it was done. I closed shop right there. I did not want to do any more trading. I called Fox Investments, was the trading firm I worked with. Told the broker, I said, send me what I got left. I can't even do it. And then when I reopened with Lynn Waldock, okay, that's how I did it. I went with Lynn Waldock. I started trading, and I built it up with there using options. And then when I got more money, I was able to trade contracts. And then when I started making more money, I was building up positions and pyramiding. Okay, in the month of July, I made $45,000. That was my over the top first win where I no longer wanted to work anymore, because that's the one that put me in a situation where I could start making $1,000 a day every time I traded the bond market, because I had the equity to be able to do it. And then everything worked step by step, slowly but surely, building up on the small little bit of money I started with off of a Nations Bank credit card, paying 19% interest because it was a cash advance basically. It didn't take long, obviously, for me to pay it off. Okay, but I was fearful of it. I know what that's like to be borrowing money. $2,600 is not a lot of money, not a lot of money at all. But I know what it's like coming from where I came from. I'm from a very modest upbringing, and I was fearful of how I was going to pay that back if I lost it. And that's why I was so gun shy when I lost $750 in one day. I didn't lose all the account, but good grief, that was half of the option premium, and went right down to what I was willing to risk. And honestly, I was only like 3 points away from where the stop loss would have been. I collapsed the trade and told the broker, "Get me out right now." The sad thing is if I would have held on to it, I could have did a 350% return. But it scared me. I didn't understand what I was doing, and I know what it's like for you guys. So when you have the aspiration to be a trader, don't rush it, because trust me when I tell you, there's so many ways to skin a cat, and you don't need a whole lot of money to do it. You can start very small. If you have enough money to open up an options account, whether you're trading stocks, because I don't believe you should be trading the shares, or if you're opening up an account to trade options on futures, okay, the opportunity for you to be able to double and triple your money a couple times a year is there. And you don't have to worry about being stopped out. You don't have to worry about putting a whole lot of money in. Okay, think about it. $300. If you just had one $300 call option at that, I'm sorry, $350 at the 32 call option. Okay, it went to over $1,090. $1,090 was the value I saw it trade to. Okay, and I screen captured it and sent it to you on Twitter. Okay, so if you invested $350, the premium was actually worth at one time $1,092. You could have sold the option right then and there. Now, you would have turned $350 into over $1,000 inside of a couple weeks. Now you do the next thing. You take the next trade, okay, and you pyramid your equity. When you can afford to buy more options, you buy more options each time you do it, okay. But you don't spend a lot on the options. See, when I first learned option trading, I didn't care what the premium cost. I was expecting it just to be 500%, 1,800% returns, and that's what I was sold on the idea of. You don't do it like that. Okay, you understand where price is. Where's price likely to go? Remember that question I told you to think about as a trader? Not where do I get in? That's what the assholes that lose money on a daily basis think. You don't think like that. Ask yourself and go into the charts and say, okay, where's price likely going? That's where the money's made. It's not where you get in at. It doesn't matter where you get in at. Where the market's going, that's going to dictate what you're going to get in at. That answers itself. But where it's going, no one knows that. Otherwise, they'd everybody be making money. But ask everybody on the retail world, they all know when to get in, because their indicator says this, their system says that. Their best friend has traded, Bitcoin for the last 12 months. They've made money because they said so, and they know when to get in because he's telling them when they're getting in. And so getting in is that's not the problem. So don't worry about getting in. The answers are not the problem. The thing that you need to worry about in this equation is, where is the market trying to get to? Where it's at now and where it's getting to. That's the money. That's it. It's it. But no one thinks like that. No one cares about that. They all want to know when to get in. Where am I getting in at? Where should I get in at? What time of the day should I get in at? If you understand the higher time frame premise, where the market's most likely going to go, believe me, money is easy to make. That's easy. Okay? The hard part is knowing when to get out. And that's also answered by, where is the market going? You see? It's a very simple paradigm shift, but try doing it. It's hard as hell. You don't think about it like that. You want to, I need to know when to get in. How much should I be risking? This is probably too much. If this trade doesn't work out, how many can I absorb? Screw that. Give me one answer. Is the market trading right now? Yeah. Okay. Where is it most likely going to go? There's your trades. It just opened the whole door. The level playing field is now right in front of you because you already know when to trade. You know what time to trade. You know how the setups look. What's the order block look like? What's the stop rate look like? That's it. There's your scenarios. It's either a stop run or a return to an order block. Done. Handled. You know when to do it. Time of day. But the problem is you're not spending time with where is it trying to get to based on a higher time frame chart because you're too worried about those friggin' 5 and 10 minute and 15-minute charts. They're not going to do it for you, man. They're not. You need to be looking at these higher time frame charts. They will tell you where the money is going to go. The money is going to drive price on these intervals, not the lower time frames. The lower time frames is just reflecting noise. It's noise. Yes, you can use it to fine tune your risk. Yes, but that's not important right now. The small little risk entries, they're not important because you can size the risk up relative to the amount of leverage. That's controllable. You're in control of that. No one's forcing you to over leverage the account. You do that. But the thing you're out of control with is where the market's going to go. So you have to submit to that and say, okay, where it's at right now, the highest probable direction is it's most likely going to want to go up or it's going to most likely want to go down. So how far should it go up to? What level should it most likely reach for? Why? Well, it wants to go up to an order block that's bearish. Why? Because it moved away from this level before. Did it get there? No. Look how it went up. Staggered and slow, staggered and slow, staggered and slow, staggered and slow. And then boom. Here's a pattern for you. Cup and handle. Look that one up if you don't know what that is. Because that's what you see on the chart right now. I hate these things. Tell me tomorrow. This is a cup and handle. Not that I trade that shit, but nonetheless, this is what it is. Okay, I believe personally, this was the washout on those that are already in the marketplace. Okay, and then I think we're going to see it snap up, and at the very minimum, I think we're going to hit this. But ultimately, I like these equal highs. I really, really, really like that. I just hope that this thing can turn around because it would be a wonderful illustration of commodity trading using options, very little money risked, and using the tools that we talk about in foreign exchange and price action, and obviously what we learned in Larry Williams' treatise on trading futures with $1 million setups. Ultimately, I think it's going to go to 3,400 and more. But I don't know if the July contract is going to be able to do it because if it stays around in here and consolidates too long, it will erode the time value on the options. So that's the only problem you have when you're trading options. So that's why if you have a big setup like this, you want to spread out your options over a period of time. So you can have some in July and you have some in the next contract month. And if you can afford to do it, the next month out. So it's really important to focus in on these lead pipe cinch trades or mega trades throughout the year because it will give you the game plan, what you should be doing with your equity. If you have $5,000, okay, you take 50% of that money and spread it across all the options that make sense on that specific idea that you're trading. That way, even if some of the options have a time decay that's greater than the ones that would be farther out, you still have the ability to make more money. Okay, and think about it. 270% return. Did you make that in your foreign exchange equity? Did you see your account go up 270% in 6 weeks? Probably didn't. I'd probably venture to say most of you probably didn't see that happen. So it's not about how fast you make money. It's how consistently you do it and how you do it, keeping risk small. This is one example. $300 could have been over $1,090 in just 6 weeks. And then now you got $1,000 and $1,090 to trade with. And you do the same thing on the next idea. Okay, and you keep doing it, and you flipping it. Now, if you get 2 or 3 times a year ideas that you can do a triple on, you're doing awesome. And you start with a shoestring budget. I have taught people when I rented a 1-bedroom apartment. When I first moved out of my aunt's house, I got a 1-bedroom apartment, and I had people that I used to work with coming to my house on a Monday night, and we would watch wrestling, obviously, as we talked about it. But I would teach, commodity trading. And this is how I would teach it to them. I would teach them options trading because they didn't have thousands of dollars to invest in either. And I believed that the option market was the best way of doing it, where it allowed them the staying power to be able to be in these moves. Okay, and I just want to, I guess, close this presentation with, not all of you are in a situation where you can trade with a great deal of equity. I understand, and I certainly respect that, because I was like that too. I didn't even have the money to trade with. I had to borrow it off of a credit card. So that tells you where I came from. And the credit card limit was a $5,000 credit card, and the maximum cash advance they would give me was $2,600. And you already heard I did 100% of that available amount, $2,600. Okay, and I was panicking every time the statement came in, because I wasn't sure how I was going to get that money, because I wasn't making much at my job. So it's amazing how 20 plus years can change things. 2 decades, the lifestyle today, and then what it was there. It was full of worry and uncertainty, and not wanting to do what I was doing, but having no real skill sets, because I was going to school at the time too. Oh man, it was a mess. But nonetheless, if you submit to the time and you do what we talk about here, okay, you don't need a lot of money, but you do need to have a consistent approach to doing it, and you got to treat it like a business. And don't worry about the minor things. Okay, the minor things are when to get in. Okay, the majors are where is it going, and will you have the ability to close it when it gets there? Because if you do that, regardless if it continues and blows well beyond where you thought it was, that doesn't matter. What matters is you thought of a plan, where it's at now, where it's going to go, and in between where it is now and where it's heading, most likely, that's your money. That's your money. And the only way you're going to get it is by you getting in with these tools or tools similar to it, and it gets you to that price level. Once it does it, profit, get out, move to the sidelines, and wait for the next opportunity. And if you do that, you carve out a career. And that's all I've done over the last 20 plus years, is look for simple little ways to get in here and harvest a profit. And then all I did was maximize that over a period of time and reinvested everything. My first couple of years, I didn't take any kind of real money out. I think the first, well, that's not true, because in June of 2000, I'm sorry, June of 1995, I went to Bermuda for a week, and that was the first experience I had flying. That was the first experience I had doing anything nice. And when I when I came when I got to Bermuda, okay, there were celebrities coming out of the Sonesta Beach Hotel, which I was staying in at the time in 1995, before they had hurricanes come through and destroy it. The Sonesta Beach Hotel was that was the hotel to stay at. And when I arrived, my oldest boy's mother, she was pregnant at the time. We were going in, and celebrities were coming out. And I'm not going to give you who they were, because it'll actually really show my age. But I knew who they were, and I was starstruck when I saw it. But they were staying at the hotel I was staying at, and it cost me $5,000 to stay there for a week, just for the rooms. And we had to pay for all of our meals and all of our stuff, obviously. But the accommodations were great. The scenery was beautiful. It was paradise. It was 82 degrees every single day. I think 2 times that week it rained for like 20 minutes, but then went right back to being perfect again. So anyway, nonetheless, I'm just rambling. I had a lot of time to think about some of the things I wanted to talk about, and I really took advantage of the no time limit stuff today. So if I didn't get to your question, I will go through Twitter this evening and fire off some responses. And if it's something that requires a little bit more thought or time, I will give it to you on Wednesday. We will not be doing anything for Tuesday. No live session on Tuesday. And I will be preoccupied. I have some things I have to do with my wife tomorrow. So my mind will be elsewhere. So it won't be on the markets. So the next opportunity for an ICT session will be Wednesday. And until then, I appreciate the time hanging out with me. If you didn't catch the entire presentation, came in bits and pieces, or had to hide from the boss and missed some stuff, it'll be in a recording. YouTube will make that link available once the high definition format is processed. So with that, guys, I'm going to wish you good luck and good trading.